Hey warriors, I hope you're all doing great. This is your friend CA Rahul Agarwal and I'm here before you quickly to discuss with all of you the CA final Jan 2026 paper of your direct taxation and to give you all the solutions that you should be knowing for this paper. Before I do that, I would like to first take this opportunity to congratulate every single one of you who has appeared for this examinations. I know Jan 26 was the first time ICI has moved to CA final level and it would have not been an easy thing for you, especially to skip your November and then move to January, spend all your Christmas holidays, your New Year times and your Pongal times going through examinations would have definitely not been easy. But for the fact that you have stuck to it, you have completed this paper means that you have done an amazing job. So yes, before even you get through the video, I would like you all to first congratulate yourself for being an amazing sport into getting through this examinations. After which, yes, it's an important thing for you to understand how your performance has been done. Now, I am going to give you my personal feedback on how this paper looks like, what is my expectation of the solution paper, and how do I think ICI has prepared this answer paper. At no point of time am I here to come and discuss with you on how your performance has been, how much marks you're going to score, and whether you will be able to clear Jan 26 or not. Trust me people, you have already given your paper and you have not just given DT here. You have given multiple papers. So yes, with moderations, without moderations, it doesn't matter. You will do an amazing job for this paper. So this is only for the purpose of mutual discussions and seeing how the performance has been. Please do not start self-doubting yourself at this stage because you have just gone through the examinations. You need a breather for yourself. So please don't doubt yourself. Give it some time and then yes, if you think that you need to start preparation once again, go forward. There is no harm in always doing something additional for another point of time. You never know, even if you clear, the additional studies you would have done will go a long way for all of you. Yes, so keeping that in mind, please do not drop in any comments saying, Rahul, this is what I've done, how much marks will I score, this is what I've left off, how much marks will I lose and all. It does not matter. At this stage, we are only here to see how bad the performance has been or how good your paper has been to that extent. Not for us to judge on how much marks you're going to score. It is a simple guesswork. Yes, yes, perfect. With that people, I'm going to quickly go through this paper. I have had the chance to go through the paper myself once. I have written some solutions here and there for my quick reference so that it becomes easier for me to close this video faster and only give you the insights rather than typing down things. So yes, paper has overall from my perspective does not look difficult to that matter. I could not find any difficult adjustments, any out of the box adjustments which could really confuse you too much. No doubts about it, the paper was definitely lengthy. For those people who would have started with case study questions, would have spent a lot of time in completing these questions, and therefore I've always told this in my class as well, that your case study question and your compulsory question always remains for the last stage. For those people who have followed the trick and have moved forward doing other questions like 2, 3, 4 and forward, you would have definitely been able to score maximum amount of marks in this paper with the lengthy which this was. Yes, so if you have followed that pattern, thumbs up to you. If you have not and you unfortunately spent way too much time, probably look at it once again. Yes, yes. On that note is what you're going to look into this paper, people. Now, I'm going to go sequentially because for me, yes, you know what, I just have to discuss the paper with you. But if you have gone it differently, good for you. Let's look into the paper, shall we? Awesome. Let's get into it. First, we're going to get into the case study question, people. I think my case study paper has the first case study as something about TDS and stuff. So if I read this question carefully, my question number 1 required me to confirm to you what is the payment of TDS which has to happen on a person called Mr. N. So they wanted some analysis of a person called Mr. N. They wanted me to confirm what is going to happen for that person. Second, the question came and said they wanted you to find the tax liability of Mr. A. So some Mr. A is there, Mr. A's tax liability has been requested out of you. Okay. Third one comes and says, in the given facts, Indeco is aspect of payment to Mr. A for lectures given, whether they were required to deduct TDS. Again, some lectures have been taken and for that they wanted you to confirm on the TDS as an e-commerce operator. So e-commerce operator 194O has been tested on this part. We have to understand that. Yes. With that understanding, let's quickly dive into the case study. Let's see what is happening here. First, it says Mr. A is an interior designer by profession. Okay, interior designer, which means professional guy. He has also delivered online lectures through an e-commerce platform. See, here is where 194O has come into picture. So 194O has kicked in and 194O has come and told you that whether you provide professional or technical services, as long as it is happening through an online platform, only 194O is the overriding section here. The relevant information of Mr. A's Indeco account is given to you. I think we can answer question number 3 directly from here. Question number 3 requires you to take 194.0. Now, if you remember 194.0, it is payment or credit, whichever is earlier. Yes. So, if I'm looking at this fact, on the first one, it is going to be 31st May. On the second one, is going to be 10th October. And the third one is going to be 31st March. Everything has been happening within the year. If I total the number is 3,40,000, 3,70,000 and 4,70,000. Now, 194.0 has a specific condition saying that when an e-commerce operator is going to provide services to an individual, in that case, no TDS will happen under 194.0 if the person is bound to be an individual and the number is less than 5 lakh rupees. Looking at the pattern says 2 plus 1, 3.4, 3.7, 4.7, which is less than 5 lakhs. Because it is less than 5 lakhs, if Mr. A can furnish his PAN number to the guy, the e-commerce operator will not deduct TDS. Look at the next line. The next line does confirm to you the fact that Mr. A has provided PAN number. With that logic, I think we can straightforward write this answer. The answer is going to be nil. Simple, straightforward. The answer is going to be nil because this person has a turnover less than 5 lakh rupees from the e-commerce operator and therefore TDS becomes not applicable. Simple, straightforward question. Next, para number 2. It says on 5th May 2024, Mr. A is providing interior decorating services to Mr. N. See, this is question number 1. So, Mr. A is going to provide interior decorating services whose business turnover is 1.99 crores. I have crossed the 1 crore turnover limit, which means TDS is going to be applicable. For his office as well as residential premises, which means I have now availed 194J services for office and residential premises. For the office premises, it was 45,000 rupees and for the residential premises, it was 65,000 rupees. Now, for those who know 194J conditions, 194J simply comes and says that you can only deduct TDS on official payments. Personal payments are going to be falling under 194M. And 194M has a turnover limit of 50 lakh rupees. So, threshold of 50 lakhs is not going to be breached here. By that logic, I can straightforward come and say 65,000 is not going to be liable for 194M. Only 45,000 is going to be liable for 194J. No business is carried out by Mr. A for residential premises, which means again this is a personal payment. Mr. A has provided PAN number, so no 20% rule will come. The normal 194J 10% criteria will kick in. 10% of 194J is what we are going to deduct. So 45,000 ka 10% answer becomes 4,500 rupees. So 4,500 should be the answer, which means the answer is option C. I think simple, straightforward question. Could not have been that difficult enough. Yes, the trick was in question number 2. I think here is where you have to be a little careful because it said Mr. A wants the tax liability. So they want the tax liability. Let's check the tax liability properly. It says first I need to find the income obviously. So let's figure out the incomes here. I have 4,70,000 coming in from my income here. So 4.7 lakhs worth of income is going to be taken up from here. Then I am going to be providing 2 services. Yeah, Mr. A is going to be providing 2 services, which is 45,000 and 65,000, if I understand this right. No, whom am I asking for? They wanted for A only, yes. So they wanted for A, so which means 45 and 65 will also get added, which is 1,10,000 rupees. 1,10,000 rupees will also get added into this computation. Then the question comes and says gross receipts from interior decorations, including one from Mr. N, which means this number is already there. If this number is already there, I don't need to take that into my income statement. Ignore it off. The number is 38 lakhs. So 38 lakhs is going to be my income from professional activity, which says excluding fees from online services. So it is 38 lakhs plus the 4,70,000 as my income statement. Yes. Next, it says for the financial year 24-25, 1,10,000 is paid by Mr. A to Tumble LLC, a social networking website with no office in India, and 1,05,000 to Doodle Inc. USA for providing online advertisement services. I am now going to pay money. I'm not going to receive money. It's not going to be part of my income tax statement at any point of time. Apart from that, Mr. A during the year has from a client in country X received 3,50,000. The client in country paid the amount after deducting TDS of rupees 50,000 as per Income Tax Act. India does not have a DTAA. I now have received extra money of 3,50,000 from a foreign guy. Notice carefully, it says the 38 lakh rupees is from Indian activities. Where am I looking at this? It says gross receipts from interior decoration from clients in India. See, which means only clients in India are covered in 38 lakh rupees. Up to the 3,50,000 is not covered into this. Now, here is where students would have gone wrong. Look carefully, it says 3,50,000 is received after deducting TDS, which means income here was not 3,50,000, income here was 4 lakh rupees. 3,50,000 plus the 50 which got deducted off. Yes, you're anyway going to claim FTC on it. So to that extent, you should have offered the full 4 lakh worth of income as your income tax statement. By that logic, if I take this consideration properly, my income is 4,70,000 from my online lectures. My normal gross receipts is 38 lakhs, which is coming from my normal operations in India. And then finally, I have some income which is coming from a non-resident guy, which is going to be about 4 lakh rupees. So that is what I'm going to take into consideration. Now, question says, Mr. A has not maintained any books of accounts as required under 44AA and wants to be assessed under default taxing after computing the profit from his profession under the special provisions, which means now they have said, my dear child, I do not want to go for books of accounts itself, go for presumptive taxation. Professional guy, presumptive taxation becomes 50% rule. Yes, so by that logic, the 50% answer will kick in, which means I'm going to take my 38 lakhs, my 4 lakh 70 and my 4 lakh rupees, and I'm going to do presumptive taxation on this. Let's see how the presumptive looks like. Taking 38 lakhs, 4 lakhs and 4 lakh 70, my income came to 46 lakh 70,000. 50% of that becomes 23 lakh 35,000. So PGBP is going to be 50% of my gross receipts. Any doubts till here? Good. Now, the question said that the person wants to go for DTR. So, DTR rules are going to apply. DTR says for the first 15 lakhs, directly offer 1,40,000. For the balance, you're going to offer at the rate of 30%. Adding that number into computation, you get 3,90,500. Simple, straightforward. Add us says answer is 4,06,120. Now, if you notice the question said they want the tax liability including surcharge and cess, but before giving any credit TDS per foreign tax credit and all those stuff, which means 4,06,120 should be my right answer, and therefore this is what the answer looks like. This is what the answer looks like. Question number B could have got the answer from there. Now, as a faculty, I would also like to give you this disclaimer that while B is the correct answer, I have my own doubts. I would like to tell you this one thing carefully. Notice carefully that I am an interior designer. Interior designer means whatever professional activities I do as interior designer will be called a professional receipt. Apart from that, if you notice, I have provided online lectures, which means I have got into teaching operations, and teaching has not been notified as a notified professional. Teaching has always been a business activity. Now, you can make two statements here. Statement number one, you can come and say, I am providing teaching relating to interior designing, so it is still professional receipt. Or option number two, you can come and say, teaching has nothing to do with my interior designing. That's a separate activity altogether, and therefore that should be a business operation. Because that is a business operation, I would have loved to offer that only for 6%. Why should I unnecessarily offer it for 50%? Yes or no? Yes. So by that logic, I can come and say you that there is a defense on this answer. The defense on this answer is alternate number 3. Where I can come and say, take my total professional receipts. My total professional receipts was 42 lakhs and the online lecture receipts, which is 4,70,000, should be offered for a presumptive rule of 6%. Yes, so 42 lakhs is going to be my interior designing and 4,70,000 is going to be my online lectures. By that logic, I would come and tell you that the first one will be going for 44 ADA, which is 50%, but the second one would only require 6%. And if I do that computation, my answer would have come to around 3,41,600, which is way lower than what is 4,06,120. And so, if you come and ask me, I would have preferred that to be the answer here. Unfortunately, the option did not match. Because the option did not match, option number B makes more sense, and therefore we are going with that. Yes. However, yes, you can make the difference at any point of time in your practical world. So notice, just because you are into teaching the same profession does not mean you are a professional there. Teaching is always going to be a business activity because it is not a notified professional. Yes, and so to that extent, I always think that it's not going to be option number B. Should have probably been a different option, but they did not give it, so we're going with that. Clear with me on this? Yes, very good. With this, answer is option number B here, and I think that's what 3 questions were there from your case study perspective. Yes. Now, what I'm unhappy about is this, that they have unnecessarily tried to waste time here. For this whole part of giving you online advertisement, giving you all that stuff, which is an EL related thing, they did not even have to give you this. They did not use this information also. So it was quite unnecessary and maybe confusing you in exams. They probably wanted you to realize that 1,10,000 would probably be treated as a receipt and not an expense. That is what they probably wanted to test you on. But luckily, if you have been smart enough, you could have got the answer as option number B right off the bat. Yes, so sometimes that is why I tell you it is more important for you to read the question first than reading the case study. Sometimes question gives you more understanding than what the case study will give it to you. Clear? Yes, I think here not a big deal. Quiz 6 marks should have been easily be able to score it off. You should have got the full marks on this. Shall we proceed forward? Let's proceed forward. I have case study number 2. Now this case study number 2 comes and gives me some issues. First thing it says, in case Seva Niketan accumulates or sets apart in excess of 15% of income, where such accumulation is not allowed under any specific provisions of the act. You're not allowing any specific provisions. What are you going to tax this on? Now people, even if you don't know the case study, you can directly write this answer. This is what we call a specified violation. In charitable organizations, when you do a specified violation, then that specified violation is directly going to be taxable at the rate of 30%. Straightforward answer. Answer is option number A. You didn't even have to read the case study. Easy 2 marks in your hand. You could have easily scored this off. Second, which of the following amounts in respect of purchase of computer will be treated as application? We need to read the question here. Third, tax payable excluding cess and surcharge by Seva Niketan in respect of anonymous donations received during the year is what? They've asked for anonymous donations. And fourth one, out of the amount of corpus donation as mentioned in 4 above by Seva Niketan, which of the amount would not form part of the income statement, which means they're asking how much is exempt. Yes, let's keep those thoughts in mind before we give the answer of. So I need anonymous donation, exemption of corpus, I need something about your purchase of computer, and the first one we've already answered off. Yes, now let's read the case study, let's form some answers out of this. Case study says, I am Seva Niketan Charitable Trust running 12AB, an educational institution and a hospital for treatment of persons suffering from mental disorder. Confirmed to you, you are a charitable organization. Trust has given the following information to you. The total receipts of the educational institution is 3.5 and hospital is 3.9. Like we discussed people, 1023C only applies to you when the total gross receipts are up to 5 crores. Here, if I notice the total gross receipts of 3.5 and 3.9 is going to jump to 5 crores, which means 12AB registration is the only thing which is mandatory here. You have to get a 12AB registration in order to get your incomes exempted off. Next, voluntary contribution included in 1 above received during the year is 115 lakhs. Out of this voluntary contribution of 115 lakhs, there is a corpus donation of 65 lakhs for purchasing building and an anonymous donation of 20 lakhs with the direction that the donation should be used for educational purposes. I think we can now answer the anonymous part. Anonymous part comes and says that you need to have an anonymous donation taxable at 30% for any amount which is received in excess of 5% of total donation or 1 lakh rupee, whichever is higher. If I notice the total donation I have received is 115 lakhs. In this 115 lakhs, if I check 5%, can you help me out quickly? Let's check 5% together, people. So what is going to be 115 lakhs into 5%? My calculator is here. Yes, so it is going to be 115 into 5%. Answer is 5.75 lakhs. Now it is 5.75 lakhs or 1 lakh rupee, whichever is higher. So I'm going to take 5.75. So out of my corpus of 20, out of my anonymous of 20 lakhs, 5.75 is going to be treated as a normal donation. So let's find out how much is my anonymous donation here. 5.75 is the answer. Removing 20 here, answer becomes 14.25. So 14.25 is going to be my anonymous donation in this answer. Yes. So by that logic, I can now find out my answer. Let's find out the answer for 14.25 lakhs multiplied with 30%. Question did not want surcharge and cess, so I'm not going to take surcharge and cess. I'm simply going to take 30%. Let's find out what is 14.25 for 30%. Answer at this stage should be 14.25 into 30 divided by 100. Answer is 4.275, which is nothing but option number D. A simple, straightforward answer. Option number D would have given you the right answer. Yes, easiest question you can answer, people. If you know basics of charitable organization, this is the easiest question you could have answered from your side. Yes, good. Let's move forward. I now have some corpus given to me. It says, during the financial year 24-25, computer for use in educational institution was 85 lakhs, which was funded as follows. I funded about 35 lakhs from corpus. People, can you take corpus? No. Because corpus is treated as exempt, then the purchase of computer will also be treated as ignorance application. You can't treat it as application then. Loan? No. You cannot treat any kind of asset purchase through a loan as an application. Only the repayment of loan will in turn become an application. So this is also ignored off. And third one says voluntary contribution. This is the only right answer here. So 25 lakhs is going to be my amount of application, which is option number B. Yes, so this is also a very simple, straightforward question. I don't think these questions deserve 2 marks, but good for you. Yeah. Good. Next one says, my corpus donation received the year are invested in the following modes. Now, whatever corpus I've invested, that has been invested in proper modes is what you have to check. Corpus has to be deposited in 11.5 modes, approved 11.5 modes. Let's check. First one says post office account. People government fund, approved, no problem, can claim. Next, Canara Bank has fixed deposit. Yes, again a no nationalized bank, can be claimed. Third one says deposit with private limited company. No, can't claim such deposits. 11.5 modes does not permit deposits with private companies. Only those things which are government securities or government related securities or immovable properties and stuff can be treated as 11.5 modes. Deposits with private company is not an approved mode, which means this is not going to be treated as an application. This is not going to be treated as an exemption. Now, question did not want how much is taxable. Question wanted how much is exempt. So by exemption rule, I think 15 and 5 answer becomes 20 lakhs. 20 should be the right answer, which means answer is option C. Simple, straightforward. I think with this we are done. Yes, amazing. We are already done with all the MCQs. I did not even complete the question. Question said amount paid to another trust to register under 12AB for donation of 12 lakhs. 3 lakhs was given as corpus. People, again, unnecessary information given to you which is not relevant to the MCQ itself. Had you gone through the questions first, you would have realized you don't even have to read this information. 5 is not relevant. 6 says amount being set apart for application. Again, not relevant at all. Completely ignorance. Yes, so by this logic, I think we could have easily answered this question just by looking at the questions, not by looking at the case study first. Yes, this is something I've repeated so many times in exams, in classes also, that please do not go in through the case study before going through the MCQ. Jan 26 has been an eye-opener for all of you. I know the questions were damn easy, but at the same time, if you wasted time on reading the case studies, you would have not completed the paper off. Yes? Good. I think this is what the case studies look like. Hopefully there are no more case studies for us to discuss. So let's quickly look into the balance individual questions. It says, I am Mr. Rajkumar, a resident and corporate employee of 2425, filing the return of income on 31 July 2024, disclosing a total income of 45,50,000. Sorry. During the relevant financial year 23-24, this current year, he purchased a plot of land in rural area for an agricultural consideration of 10 lakhs. People, rural area is not going to be treated as a capital asset. The value of the plot as per stamp duty value is 19.5 lakhs. I don't really care. The return has been selected for scrutiny and the FAO has issued a notice to Rajkumar to show cause as to why the 9.5 lakhs between the difference of stamp duty and actual consideration should not be added to the income statement of IFRS. Officer is asking, why did you not add it? Ideally, you should not do it, but whatever. Mr. Rajkumar has actually purchased the plot of land for 10 lakh rupees. However, he is worried that FAO is not going to accept his version after the assessment order. He may face a penalty for underreporting and prosecution for willful attempt to evade taxes. Now, assessee has become very scared. Assessee is coming and saying, if I don't approach it properly, then he is going to start levying penalty and prosecution on me for evading taxes, and I am extremely scared. After the assessment order is passed, which amongst the following is an option available to Rajkumar to get the dispute resolved? They're asking what and all remedies should you take for you to get the dispute resolved here. First one says filing an objection before DRP. People, DRP, for those who know, is dispute resolution panel, given only for transfer pricing matters. This is not a DRP matter and therefore this is not going to DRP, not allowed. Second, filing an application before DRC. DRC is Dispute Resolution Committee. DRP and DRC have extreme amount of differences. We have discussed this in class as well. DRP is for TP matters. DRC is for settling matters of penalty and prosecutions. So which means option number B gives the right answer. Filing a grievance petition is not going to help because an officer is never going to take it into consideration whatsoever. And then filing an appeal before Principal Chief Commissioner. People, there is nothing called appeal before Principal Chief Commissioner. Before Principal Chief Commissioner, you can only file a revision petition. Yes, 264 is what you can file, but this is not the right answer. Answer should be option number B. Yes, so option number B should be the right answer. That seems to be the most appropriate answer here. Very simple, straightforward. Yes, too much English given to you. At the end of the day, you could have written the options from there itself. 9 says, I am Raman. Raman is a resident during the financial year 24-25. In addition to the income under the head salaries of 20 lakhs and income from other sources of 70,000, which means I have 20 lakhs and 70,000 worth of income already reported to me. Out of that, it says they have now earned the following incomes also. Income number 1, it says profit on 3,50,000, which is sale of cryptos held for 36 months. People, VDA transactions are going to be liable for a tax at the rate of 30%. Next, loss of 20,000 on cryptocurrencies. Income from VDA 30%, loss from VDA fully ignored. Can't claim any losses and all. Can you set off, Rahul? No set offs and all is happening. This is the final answer. Gift of virtual digital asset 1 lakh rupees. People gifting virtual digital assets goes into IFOS statement. So it is going to be taxable at IFOS. Next, short-term capital gains of 40,000 rupees on sale of listed equity shares paid on 1st July 2024. Before 23rd July, before 23rd July makes it liable for 15%. 1 month money rules are applying here. Tax payable by Raman excluding cess and surcharge in respect of profit on sale of crypto, VDU received in gift, and short-term capital gains has been requested out of you, which means only 3 incomes have been requested. Salary given to you is not relevant and IFO is given to you is not relevant. They only want the other information. Now Rahul, this is a little unfair from my side if you come and ask me. Think about this. The VDA, I know special rate 30%. So 3,50,000 ka 30%, I can straightforward find the answer. Loss anyway is going to get ignored. Short-term capital gains also 40,000 into 15%, I can straightforward find the answer. Problem comes on IFOS statement. IFOS is going to be liable for slabs here. Now, how do I know what slab is he going to be? That is the reason why they've given you salaries and IFOS here. If you notice, my salary and IFOS is 20 lakh and 70,000, which means I'm already crossed the threshold, whether I'm in old regime or I'm in new regime. Any income after this 20 lakh 70,000 is going to be taxed at a flat rate of 30%, last slab. Yes, that is why probably they gave the statement for you to confirm that the 1 lakh is going to be taxable at the rate of 30% at this stage. Yes, although I would not prefer giving such vague statements, they could have rather come and said find the full tax payable. You could have done that easily. Yes, I don't know why they have to confuse you too much in examinations, but nevertheless, this is what the statement looked like. So if I have to find the answer right now, I'm going to take 40,000 into 15%, which is 6,000 rupees. 1 lakh into 30%, which is going to be 30,000 rupees, and then gives me the last one, which is 3,50,000 at the rate of 30%. Let's find what is 3,50,000 at 30%, people. 3,50,000 at the rate of 30% gives me the answer as 1,05,000. So on this 1,05,000, I'm going to take 30,000 and 6,000. So which means 36,000 is going to be added in my statement. Answer is going to be 1,41,000, which is option number A. Yes, I think this was fairly easy, but they did not have to unnecessarily confuse you on this. You could have found the answer in the first go itself if you had just used your brains to come and say 30% is what you're going to tax IFOS. That is all the statement was. Yes, take that into consideration, and 1,05,000 would be the statement, which means option A gives you the right answer. Again, not a very difficult one, could have been managed. Could have been managed. Yes, good. That gives me the last one, I think, people. No, oh, we have another case study 3. Oh God, that is why this paper was difficult. Look, it says Shark Shipping International non-resident foreign company engaged in the business of cruise ship. Amendment of the current year. Amendment of the current year comes and says when you operate a cruise ship, 20% of the profit receipts which you receive will be taxable as PGBP income. Yes, eligible for presumptive. Ship operates between Chennai, Andaman and Lakshadweep and provides a complete package including dining and cabin facilities. All conditions have been satisfied. During the financial year, the profit from the operations is 50 crore rupees. In this 50 crores includes 10 crores by various travel agents for booking the cruise on behalf of Shark Shipping. People, 50 kulla 10 crores is already there, which means I don't need to exclude, and this is a proper presumptive income taxation. The expenses for operating the ship is 15 crores. Can't claim. No claim of expenses against presumptive taxation. Based on the profits, you're simply required to tell me what is the income which is to be taxable at presumptive basis. People, 50 crores was the number. 20% का answer. Answer is option C. इससे ज़्यादा easy क्या होगा? Yes, easiest question. You could have easily scored 2 marks on this. You don't even have to read the question properly. Presumptive taxation, 50 crores, 20%, 10 crores is the answer. That's all, full stop. Yes, yes, easy question, people. I think we are at the last one. Oh yes, we are at the last one. Let's look at the last MCQ. It says you are at integrated case study number 3. It says on 1st April 2024, UI Limited is an Indian company and is borrowing 50 crores at the rate of 10% per annum from M Inc., a US entity, thereby increasing the total borrowings to 70 crores. UI Indian company is going to borrow 50 crores and make the total borrowing is 70 crores. People, transfer pricing conditions, AE rules come and request that a person can only become an AE to you when the borrowings exceed 51% of total assets. Not the total borrowings. I don't care about the borrowing. 70 is not relevant. I need to check this 50 crores with my total assets worth. I think if I'm looking at this somewhere, I found it here. See, it says the total assets is 180 crores. 50 by 180 is not going to give you 50% exceeding, and therefore the answer is going to be non-AE, which means I can confirm M Inc. is going to be a non-AE for me. They are not a related party. Clear? Yes. Next, there is the said loan is then guaranteed by H-Inc. and other US entity. Here is where the problem starts. A very beautiful question created, people. Notice, even though loan is a different person, guarantee is from a different party. And guarantee rules come and say that if a person is going to guarantee more than 10% of your total borrowings, if 10% of the total borrowings have been guaranteed, then it is going to be an AE. My total borrowings is 70, 50 crores has been guaranteed of, which means technically I have guaranteed more than 10%. H-Inc. is now a confirmed AE to you. Yes, so H-Inc. is going to be declared as a confirmed AE to you. This is going to be liable for transfer pricing conditions. Yes, good. The place of effective management of both M-Inc. and H-Inc. is in USA, foreign parties. The UI Limited is importing telecommunication equipment worth 22 crores from H-Inc. to resale in India for independent customers. I see resale here, which means I am now going to have RPM, resale price method, coming into consideration. The import duty is 4.5 crores and the same was paid by UI Limited. The equipment was sold to customers for 30 crores. My sale price has been confirmed to me. Normal GP margin is 20% on sales. People, RPM method says what? Take the sale from unrelated party, reduce the normal gross profit, any incidental expenses, and you will arrive at the purchase price. Yes, so by that logic, I think I've done the computation here. My sale price was 30 crores. My normal GP margin has been confirmed as 20%. So 20% on sale became 6 crores. Reducing number is 24 crores. In this 24 crores, I had to pay some import duty. Import duty becomes 4.5, which means my arm's length price was 19.5 crores. In this case, 19.5 crores is what UI Limited should have paid to my third party, to my associated enterprise. However, question says that I purchased it for a price of 22 crores. You paid more than what you were supposed to pay. If you paid more, the profit in India is showing lower. If the profit is showing lower, TP will apply to you, and therefore there will be a TP adjustment of 2.5 crores. Yes, a TP adjustment of 2.5 crores will be attracted to you in this case. Clear? Yes. Now, I know there are some students who have this misconception in the market where they'll come and say, Rahul, you purchased it at a higher price. TP is showing, actual transaction price is showing more than ALP. Why do you want to do TP adjustment? Understand, that's not how you're supposed to read it. TP applies when India is going to lose cash. Here is a case where India should have only paid 19.5, but India is paying 22, which means India is losing cash here. TP will apply in this question. Yes. So 2.4 crores worth of TP adjustment will be attracted in this question off for you. Next, it says net profit of UI Limited was 10.25 crores after debiting interest of 6.25 crores, out of which 1.25 crores was interest pertaining to borrowings made from unrelated party. I think 94B is going to come into picture. Depreciation is 2.5 crores, income tax is 1.5 crores, interest expenditure of 2 crores was disallowed in 24-25. I have some disallowance coming for 24-25 on account of interest paid to foreign enterprise of that year in respect of debt issued to non-resident associated enterprise, which means that year I had some 94B disallowance. For those who know, 94B disallowance says when you disallow some interest in the past years, you can claim it for the next 8 years, provided in a year in which the EBITDA is up to 30%. Yes, which means this has to be treated separately now. I think I have all the facts in my hand. Let's now compute the number. What is happening? My net profit is given as 10.25. So I took the 10.25 of net profit. In this 10.25 of net profit, I am going to disallow the complete interest. Yes, notice it says 30% of EBITDA. EBITDA means any interest, whether AE or not AE, I don't care. Which means I am going to take my complete 6.25 crores worth of interest into computation. So complete 6.25 crores of interest, depreciation is 2.5 crores and tax is going to be 1.5 crores. Yes, so depreciation becomes 2.5, tax becomes 1.5, EBITDA has been confirmed as 20.5 crores. Now, I can pay maximum of 30% to my group companies out of this EBITDA. So out of 20.5, if I take 30%, answer is 6.15 crores. 6.15 is what I can maximum pay as interest in the current year to my group companies. Now look carefully, how much have I paid? It says out of 6.25 crores, 1.25 crores pertains to my third parties, which means 5 crores pertains to group companies. Where is this 5 crores coming from? It is coming from here. It is coming from here. Now, let me explain this once again carefully for you so that you understand. And this is a very beautiful way of ICI putting this out to you. Understand, the 50 crores of loan may have been taken from M Inc. M Inc is not a related party, no doubts about it. But notice that H Inc has guaranteed this. And 94B rules come and say that when a third party gives you a loan and your associated enterprise either guarantees the loan or provides a matching amount in that bank or whatever institution it is, then that will also attract 94B. Here is a case where even though you took the loan from an unrelated party, because H Inc has guaranteed this loan, 94B gets attracted on that element also. So to that extent, the 5 crores is liable for 94B conditions of. Yes, so 94B will get attracted on that 5 crores worth of payment. A very beautiful and a very minute adjustment which ICAI tried to test you here. Yes, you should have been careful about this. Yes, so what really happened, people? You took a loan from a third party. AE has guaranteed the loan, which means the loan has now become tainted and therefore 94B gets attracted here. I can take total 6.15 worth of claim. 5 crores is the total claim which I have from the related party in the current year. Apart from that, question says 2 crores worth of interest was disallowed in the past year, which means I have now 7 crores worth of interest which I could claim. But you can only claim up to 30%, which means 6.15 crores is what you could have maximum claimed as interest deduction to related parties. Yes, so by that logic, what I've done taken the total EBITDA, 30% is 6.15, total interest pending to claim is 7 crores, which means least of the two, 6.15 crores is what I can claim to my related party 94B. Clear enough with me on this? Yes or no? Yes, a very beautiful adjustment, people, and you should definitely pay attention to this one. For all my students writing May 26 and forward, you should definitely focus on this once again and see if you understand it. Yes, good. That brings me to the last para. The last para says Jennifer is a director of UI Limited. During the financial year, visited USA and has stayed there for a period of 90 days. Yes, so I've stayed there for a period of 90 days. During that period, she opened a bank account with a branch of USA and has deposited an amount equal to 50 lakhs, which means Jennifer has gone to USA and deposited 50 lakhs. The said amount was deposited by remitting the money from a bank account in India out of the salary income earned by her in India and duly disclosed in the return of income. I have had some income in India, transferred it off to US, and US have created a bank account. The balance in the foreign bank as on 31st December and 31st March is given as 4 lakhs and 1 lakh. Okay, balances are given to me. Neither any interest is credited was or allowed by the bank of the USA branch during the financial year, nor any income was arisen in the investment in shares of USA company directly or indirectly, which means I've bought some shares, I've bought some bank account, neither has given me dividends or interest whatsoever. I just have some assets in my hand. Mrs. Jennifer has not disclosed the foreign bank account and investment made in the shares of foreign company in the return of income filed for 24-25. Now, even though you have no incomes coming from foreign assets, Black Money Act has a mandate. Black Money Act comes and says that whenever you have any assets located outside India, you need to mandatorily disclose that in the return of income. Failure to disclose anything which is there in outside India can trigger a penalty of 10 lakh rupees. Yes, 10 lakh rupees worth of penalty can be triggered. Based on the information received under automatic exchange, the assessing officer has served a notice under Black Money Act. See, they have now given a black money notice for asking Mrs. Jennifer to explain why the penalty for Black Money Act should not be imposed on her for the bank accounts and the investment which is not disclosed. During the financial year 23-24, Mrs. Sham, father-in-law of Mrs. Jennifer, on the occasion of her marriage, has gifted 20 lakh rupees by way of issue of check on a date of marriage in her name. So in the financial year 23-24, Sham, father-in-law of Mrs. Jennifer, father-in-law of Mr. Jennifer, on the occasion of her marriage has gifted 20 lakh rupees. People, any gift given on occasion of marriage will not be triggering any kind of IFRS taxability. Mrs. Jennifer invests this gift amount in a fixed deposit with a private bank in Mumbai. Here is where the problem is going to start. For the first time again after September, I'm surprised at CA final level they're testing you on clubbing rules. Yes, notice people, clubbing has a specific rule. Clubbing says when you transfer any kind of assets or income to your spouse or to your son's wife, then whatever income the spouse or son's wife earn will be taxable in your hands. Notice Mr. Sham is the father-in-law of Mrs. Jennifer, which means Jennifer is the son's wife. And because he gave gift to her, whatever income she earns will now be taxable in the hands of Mr. Sham under clubbing rules. On the said fixed deposit, 80,000 was accrued during 23-24 and 1,20,000 was accrued during 24-25. She disclosed the said accrued interest in her return of income filed for the relevant year. She said, no clubbing and all, I will do it in my hands. Under the income IFRS, that is what the statement says. Now we need to figure out the facts properly. Let's look at the questions. In respect of transactions of telecommunication equipment for UI and Hench, which is from resale price method, what is the transfer pricing adjustment? I already showed you the calculation. The answer was 2.5 crores. Easy. In the given facts, Mrs. Jennifer was required to disclose the foreign bank account and return of income. Yes. Not required to disclose. Definitely not required to disclose. No. Required to disclose the foreign bank account in a return of income only if a total income was above basic exemption limit. No. People, section 139(1) has a clear mandate. 139(1) clearly mandates that if you have any kind of assets located outside India, or if you are a beneficial owner of any foreign bank account, you need to mandatorily file a return and disclose all those assets of. Even 1 rupee is not permitted to be kept aside. You have to disclose the complete number. Third, the amount of penalty which the assessing officer may impose under Income Tax Act for non-disclosure of investment and shares in US company in FA schedule of the return by Jennifer shall be what? People, I think this is a little bit of a tricky question. Either ICI was being very conscious in asking this question, or they unfortunately made a mistake. Like I discussed with you, Black Money Act comes and says that you can levy a penalty of 10 lakh rupees for non-disclosure. Notice the question comes and says they don't know Black Money Act. They're saying how much penalty can be levied under Income Tax Act. Now this looks like a mistake. From my perspective, if you say that they did not want to test you on income tax but rather test you on black money, then the answer is option number C. Or you can come and say, no, this was a deliberate intention from ICI, where ICI did not want to test you on Black Money Act, they wanted to test you on income tax, in which case the answer will be option D, nil. Yes, so I think the answer on this, from my perspective, honestly, this can be an oversight. A student in the hurry of an exam would not realize this minute difference of income tax and black money, and therefore, yes, ICI should consider this as an opportunity and give them answer for both C and D. C and D should be right. That is what ICI should come and do. If for unfortunate reason ICI goes with D, then yes, that's a mistake. Yes, that is a mistake that you have to keep in mind. But hey, conscious call. I don't think this is going to be significantly impacting you. 2 marks is fine. Don't take it on your heart. It's okay. I understand there is a mistake which has happened. I really hope ICI will give you extra marks for it. But even if not, trust me people, all the questions we have done, this is the only thing which has been made a mistake upon, which means you can let it go. Keep it okay. Yes. Good. Which of the following statement is correct in respect of money worth of 20 lakhs gifted by father-in-law to Mrs. Jennifer? Mrs. Jennifer is required to disclose 20 lakhs as her income from other source. No. Mrs. Jennifer correctly included interest of 80,000 and 1,20,000 in her return of income. No. Mr. Shyam is required to include the interest of 80,000 and 1,20,000 in his returns. Yes. Mrs. Jennifer is required to include 20.8 lakhs in her return of income. Definitely not. Related party, IFOS will not ask you for tax on the 20 lakhs. Not going to be taxable. Yes. Good. That gives me the last question. The last question says, find the amount of allowable deduction of the computation of total income for the interest in the current year. Now here is the catch point. People, we just discussed it and I told you the maximum interest which can be allowed as deduction is 6.15. Yes, but again, what we are not realizing here is this 6.15 is all that interest which you have paid to your related party, which means apart from that, to your unrelated party also you have made some 1.25 crores ka interest. Where is it? Yes. See, of the 1.25 crores worth of interest which you pay to unrelated party, technically that is also an interest which you can claim as deduction. Yes, so by that logic, if you look at it, it says what is the total amount of interest which is to be claimed as deduction, which means they want the related party interest plus the unrelated party interest as deduction. And so by that logic, what I would say is 6.15 was the total interest you can pay to related party based on 94B, and 1.25 is what you can pay to unrelated party based on 94B, making a total interest claim as 7.4 crores. 7.4 crores becomes option number A. This I think is a little bit of a vague question, a little bit of a trick question, people. But then again, 6.15 was never even there in the item options given to you. Yes, so because 6.15 was not there in the options, the only making sense option would have been option number A. So if you would have noticed it carefully, you would have seen it does not say interest from related party, it says interest. When it says interest means all interest to be considered, which means 6.25 plus 6.15 plus 1.25, both should have been taken into consideration for giving your answer of. Yes, that is what the answer is. Answer is option number A. Clear? Yes. Good. This is your MCQs, people. Now, if I'm looking at my time chart itself, we are at 43 minutes. This itself shows the MCQs were lengthy. Yes, it was not an easy thing. It definitely was lengthy. 30 marks of MCQs took me about 45 minutes. And ideally, MCQ should not take that much time. Yes, you can minus off all the times which I was explaining to you. Ignoring all that also, I think yes, the MCQs were lengthy and so should have been attempted in the last. If not, you could have at least only attempted the individual MCQs and not the case studies, because the individuals were manageable. The case studies is where you have to spend too much time on things. And so yes, to that extent, I agree, MCQs were lengthy. Yes, but hey, this is what the answers look like and I hope you have understood all those things. If you have already scored good marks in this MCQs and have done extremely well, good job, thumbs up to you. If you have made some errors here and there, probably it's completely fine. It's okay for you to realize your mistakes. If you clear with that, learning for future. If you don't clear with that, keep it in hand so that next time you don't make this mistake once again. Yes, 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 good. Let's dive into what is your theory descriptive part of the questions and let's see how much difficult those questions were. Let's do the descriptive part of it. Yes, we are going to start with descriptive. Again, I'm going to go in the same sequence. I am not going to be solving any question, people, not going to give you final answers. My intention here is only to tell you how to approach an adjustment. Yes, that is what we're going to do. Otherwise, it will go for a long amount of time and I don't want to waste too much time on this video with all of you. Yes, you've already done the paper. You know how to approach it. We're just looking at discussing this. So let's look at question number 1. Again, the lengthier question, the comprehensive question. I'm going to quickly go into the last line just to see what does the question say. The question says, you are required to compute the total income and the tax liability of M Auto for the assessment year 25-26 under regular provisions of the Act, applying and enabling the provisions of each thing, assuming that the assessee has not opted for concessional tax regime. Go for normal tax regime. Now, for normal tax regime, you need to find out what is the turnover of the case. So the question comes and says the turnovers are given to you as 300 and 350 crores. Now, people, whether you take 300 or 350, it is less than 400 crores. So it anyway does not matter. 400 crores means you're going to be liable for a tax at the rate of 25% plus surcharge and cess if at all applicable. Yes, next, would it be beneficial for M Auto to offer beneficial tax rates for the financial year 24-25? Support your view accordingly. So which means we need to also check for whether it is happening in new regime or old regime. We also need to figure out whether there's any changes to be made in the regime. Yes, so that is what the fact pattern is. With that logic, let's look into the question. Let's understand the adjustments of. It says, I am M Automobile Limited. M Auto is engaged in manufacture of automobiles, which means the moment I see manufacture, I know I'm going for additional depreciation. Yes, at spare parts in Lucknow. In June 2024, M Auto has established a new unit at Patna for manufacture of automobile accessories, which means a second manufacturing operations is starting. However, notice it is only starting in the current year. Normally, people would have an assumption saying, Rahul, new manufacturing company, let's go for 115 BAB. No, understand that provisions already got redundant last year itself, which means current year, even if you start a new operations, you are only going for 115 BAA. You're not going for 115 BAB. 115 BAA is going to be applying on both the scenarios of, yes, separate books of accounts are being maintained for both the businesses. Okay. The statement of profit and loss account is given to you for the Lucknow unit before charging depreciation. So they have confirmed to you that I have not charged depreciation yet. Without charging depreciation, the answer is going to be 50 lakh rupees of net profit statement. So net profit of rupees 50 lakhs has been confirmed to you. Let's keep that in mind. This is my starting point. Next, let's go forward. It says, you are going to take into consideration the debit and credit of the following items. These items are already there in P&L. Let's look at it. It says commission of 2,50,000 was paid to Robert, a non-resident who has not any offices or permanent establishment in India. The payment was made without deducting tax at source. Section 40I triggers. 40I comes and says when you make a payment without TDS, you will be liable for 100% of the amount as disallowance. However, we have discussed this in class as well, people. When you make payment for export commission, for any kind of commission paid outside India for procuring foreign orders, there is a Supreme Court judgment which comes and clarifies you do not have to deduct TDS because the payment was never liable to tax in India. The non-resident is sitting outside India. The services are being delivered outside India. All activities taking place outside India has nothing to do with India payments. So Mr. Robert was anyway not liable to tax in India. By that logic, TDS will also not apply. If TDS is not applicable, then there is no reason for you to disallow, which means this adjustment will get ignored. This adjustment will get ignored. This has come so many times in examinations. I hope you have done this right. Yes, good. Second one says a standard warranty is provided at the time of sale, which the product would be replaced free of charge in case of a manufacturing defect. The provision for warranty is taken at 0.5 percentage of sale amounting to 5 lakh rupees. Again, same thing we have discussed in class people. When it comes to provision, income tax says only provision for unascertained liabilities are disallowed. If it is going to be provision for bad debts, then specific disallowance under 36. Any other provision will trigger ICDS 10, and ICDS 10 comes and says when you have made a provision on scientific basis, there is a legal validity for the provision. In that case, no disallowance will take place. Provision for warranty is one of the examples. Provision for warranty is always made on scientific basis. Here also they have come and confirmed that it is 0.5 percentage of sale, which means this is a scientific basis provision and can be allowed as deduction. Since it is already there in P&L, no adjustment is required, which means again adjustment will get ignored. I hope this makes sense. Yes, good. Next one says assessee has contributed 6 lakh rupees at 20% of the basic salary to the account of employees under National Pension Scheme. Amendment of current year, and I remember telling this to all of you that it is extremely important in examination. Now, I have a bit of a reservation on this. The amendment comes and says that you cannot contribute more than 14% of the employee's salary as NPS. And salary there means basic plus DA forming part, which means technically a person is supposed to come and tell you what exactly is his DA. Now in this question, they have simply come and said 20% of basic salary, have no mention about DA, and I checked the whole question, I don't see anywhere DA being mentioned, which means I will now make an assumption that that employee was never eligible for DA. And if the employee is not eligible for DA, then I don't even have a problem here. In which case I can come and say 20% of basic salary was contributed. You could have only contributed 14% of basic salary, and therefore the differential 6% will get disallowed. Yes, so by differentiating disallowance, I did cross multiplication. My answer came to 1.8 lakhs worth of disallowance. This 1.8 lakhs will get disallowed whether you are going under old regime or new regime. The provision remains the same. I hope this makes sense. Again, disputed question. I don't know what the right answer is. I don't know what the DA is, and therefore you can make alternate assumptions. But yes, I have made an assumption. There is no DA in the question, and therefore 6% will get disallowed here. Now, the student who got the paper from has unfortunated in 10%. He did not focus on the amendment. There was an amendment of 14, and therefore you should have paid attention there. Unfortunate enough, nevertheless. Yes, move forward. The company issued 10,000 debentures during the year, out of which 2,000 were convertible into shares after a period of 5 years. Expenditure incurred on the issue of debentures were 3,50,000 rupees. This is one adjustment I've spoken about so much in the class, where many students have this assumption where they'll take this expenditure and they will start amortizing it over 5 years. There is no such provision in the act. In fact, there is a court decision which comes and confirms that when you have incurred expenditure for debentures, you can claim it in the first year itself. You don't need to amortize it over the year. This is perfectly permitted in the current year itself. You've already debited it to P&L account, which means no adjustment was required. Again, ignore. Student unfortunately here also has done 1/5, which was not supposed to be done. You did not have to do that. Yes, next. The company's branch office was located in an old office taken on rent under a lease agreement with the lessor. During the financial year, with the consent of the lessor, the old building was demolished and a new office building was constructed at the site of rupees 20 lakhs. Under the agreement, the company was permitted to reoccupy the newly constructed building for a period of 20 years at the same rent, which means I as a tenant have now incurred additional heavy cost of 20 lakh rupees, and in return, the owner has come and confirmed to me that I can continue in the building with no additional charge. People, two ways to answer this question. The answer in both the questions luckily has not changed. So two ways to answer this question. One, you can make an assumption that even though you are not the owner of the building, the heavy cost which you incurred on this is a deemed acquisition. So deemed building will come into picture, which means 20 lakhs will get capitalized in your books of accounts, and you can claim a 10% depreciation same as building, which means you can depreciate for 2 lakh rupees. Yes, option number two, you can come and say the additional 20 lakhs which I paid right now is like payment of advance rent. I've paid it in advance right now, which I'm going to utilize over the next 20 years. I could have not paid this money and the owner could have done it, but because I have incurred it, I'm recovering this money from the tenant, from the owner. In other words, I am coming and saying where I should have paid additional rent every single year in the future, I am now only paying the same rent, which means additional rent has been waived off for me because I paid 20 lakhs in the current year. Now, regardless of how you look at it, it was 20 lakhs for 10 years, which means the answer, 20 lakhs for 2 years, which means the answer would have been, yeah, I think the answer is going to change accordingly. So it is 20 lakhs at 10% will be 2 lakhs, and 20 lakhs by 20 lakhs for 20 years will become 1 lakh. Yes, unfortunate enough people, which means you can make both assumptions. You can make assumption number one where you can come and see the asset will get capitalized and therefore you can depreciate at 10%. I thought the more viable assumption here would be to come and say 20 lakhs which is paid is recoverable from the owner at a future date and in the form of paying lesser rent. because I'm paying lesser rent in the sense I'm not paying more than what I was originally paying, I can claim it as an amortization. So 20 lakhs divided by 20, amortize 1 lakh rupee, you can claim in this current year. You have debited the full 20 lakh rupees, the differential 19 lakhs will get disallowed. Yes, so this is my view on this answer. I believe 19 lakhs is what should be disallowed. There can be a view where you can come and say you would like to claim depreciation on the 20 lakhs, which means you would like to claim 2 lakhs and disallow only 18 lakhs. Either way works, people. One assumption I'm pretty sure will not come out is the fact that 20 lakhs fully debited to P&L account and leave it as it is. That is not going to happen, because you are paying this 20 lakh rupees for getting a promise that you will use the land for next to 20 years. By that logic, you cannot claim this 20 lakhs in the P&L. So yes, either 1 lakh can be claimed or 2 lakh can be claimed. Is completely your choice. You can make a choice accordingly and you can make a suitable assumption. Please put it in the comment section and let me know what is your thought on this, and we can deliberate about it as well. Yes, this is what the adjustment should be. Next, additional information says, people, additional information itself means that it is not part of P&L unless stated otherwise. Yes, so it says during the financial year 24-25, M Auto has entered into an agreement with Garg Auto Limited. As per the agreement, Garg Auto has agreed to not engage into manufacturing of automobile spare parts at Lucknow, which means I've paid non-compete fee. On 1st May 2024, the assessee has paid 12 lakhs without a deduction of tax at source as non-compete fee to Garg Limited. Yes, now two things can happen here. One, a student can come and say, because you have not done TDS on this, they would like to disallow 30% because 194J is applicable. Unfortunately, that is not the answer. Until this attempt, there is a case decision which ICAI has given in the past. We have it in our solutions guide as well, people, which comes and clarifies that if you pay non-compete fee is not going to incur, non-compete fee is like a capital expenditure. And therefore, this capital expenditure will be disallowed and will not be claimable for depreciation also, because there is no asset coming into existence. Yes, there is one decision, I don't remember the name properly, but in my solutions guide we have it, which says if I pay non-compete fee to my partner, then whatever non-compete fee I pay to the partner will be treated as a capital expenditure without any depreciation on it. Yes, now I also want to give this disclaimer to you that if you're going for May 26 and forward, I am pretty sure a Supreme Court judgment which has recently been notified, which comes and clarifies that a non-compete fees is going forward a revenue expenditure. There is going to be a significant judicial pronouncement which is going to come for May 26 and forward, where they will confirm that non-compete fees is a revenue expenditure. But till this attempt, I have a gut feeling that this should be disallowed. This should be disallowed because that is what ICAI is going to take an impression on. If the suggested answers comes with an impression where they are relying on the Supreme Court judgment, I would unfortunately not be very comfortable with that. That judgment was never notified for your books and therefore should not be tested in your examinations, but you never know. I think in this, both alternate assumptions would work out fine. 30%, yeah, probably may not be the right solution here is what my gut feeling is. Good. Let's go forward. It says net profit before depreciation from the business of automobile accessories is 25 lakhs. Now notice carefully, the line in the starting itself came and said that the net profit given to you above is only for the Lucknow unit, which means the automobile accessories unit was never part of the P&L. This has to be separately included. So I need to add an additional 25 lakhs. I hope you notice this carefully and you did this properly, people. It was not a very tricky adjustment, but still important for you to keep in mind. Next, it says details of plant and machinery, rate of depreciation is 15% is given as follows. Opening WDV was 14,75,000 and all the machines were sold on March 2025 for 15 lakh rupees. Notice in the current year itself, whatever plant and machinery I have disposed it of, which means my sale value has become more than my cost value. Because my sale value has become more than my cost value, you cannot continue depreciation. You need to stop and you need to move to short-term capital gains. And therefore, the differential number of 25,000 is going to be taxed under the head short-term capital gains as slab concept. It's a company, so therefore you can follow the 25 or the concessional tax rate as the case may be, whatever it is. This is what the answer should be. Yes, next, coming to the Patna unit. The Patna unit has bought an old machinery for 10 lakh rupees. People, old machinery bought meaning it is not going to be a new machinery. Additional depreciation not eligible, which means 15% depreciation you could have claimed on this. Second, new machinery is purchased in August 2024 for 6 lakh rupees. Now, this is a new machinery, which means on this you can now claim additional depreciation. So, 15% of normal depreciation plus 20% of additional depreciation could have been claimed by you. However, the question also came and asked, do you want to opt for concessional tax regime? So when you opt for concessional tax regime, this extra 20% which you claimed, you simply had to reverse it. So you could have reversed the 20% and you could have found the revised total income for you to compute the concessional tax regime. That is the only difference here. Yes. Next, a plot of land which is purchased by the company in 2010-11 was compulsorily acquired by the state government on 10th December 2022. Compulsory acquisition has taken place, people. Capital gains. The original compensation awarded was 10 lakh rupees, out of which 8 lakh rupees was received in 10th April 23 and the balance 10 lakhs was received on 1st October 23. All happening before the year. Original compensation rule says it will be taxable in the year in which the first installment is received. Here the first installments have been received in 23-24. I am in 24-25, which means these provisions are not relevant to me. I can skip it. Next, on an appeal made by the assessee, the court awarded an additional compensation. Enhancement of compensation has taken place of 7 lakh rupees. Out of this, 4 lakh rupees was received on 14th October 2023 and 3 lakh rupees was received on 1st February 2025. Now notice again, 14th October 2023 was received on 4 lakh rupees was received last year itself, which means again that is also not taxable. The 3 lakh rupees which I received on 1st February 2025, this is the only number that I have received in the current year, and therefore this is the only thing which I am going to tax. Now, enhanced compensation rule says you can tax it at the same slab as what the original compensation was. Because the original compensation was in 2011 and was acquired in 2022, which means it was a long-term asset. This is also going to be treated as a long-term capital gains. You can take it as a long-term capital gains and tax accordingly. Notice the the receipt is on 1st February, which means you can tax at the rate of 12.5%, new regime after 23rd July. Yes, so after 23rd July, and therefore you're going to tax at 12.5% on the 3 lakh rupees. Coming to the next part, it says the court further awarded an additional interest on compensation of 12 lakh rupees on 20th March 2025. Again, same year I've given interest on additional compensation. People, interest on additional compensation is taxable under IFOS, and IFOS comes and says whatever interest you get, 50% alone is taxable because the remaining 50% is allowed as deduction. So out of the 12 lakh rupees, I'm going to only tax 6 lakh rupees as my IFOS income, and that is what the statement will be. Now, because this is all part of additional information, my understanding is it is not part of P&L, so don't make any adjustments there. Simple, straightforward, 3 lakhs goes to LTCG and 6 lakhs goes to IFOS. That is what the answer is here. Clear? Yes, good. That brings me to the final conclusion, and they say compute the total income. Now, people, on a high level, I have not computed the answer, but on a high level, if I'm noticing 50 lakhs and then all the adjustments which I made, number crossed 1 crore. Because the number crossed 1 crore, IF came and suggested saying you have to claim additional surcharge of 7% on this. Yes, so 7% surcharge will apply on this question, and therefore you have to compute the tax accordingly. Although notice there is a long-term capital gains now, that alone has to be going for 12.5%. So you will take that 12.5%, and on that 12.5%, you're going to apply a 7% and a 4% cess. This is what is going to be in the normal computation. In the special question with the special regime, only one thing you have to do, you have to take your additional depreciation which you claimed on the Patna unit, reverse off that additional depreciation, and you'll get the answer. On that answer, now you will calculate 115 BAA, which is 25.168, flat to 22 plus 10 plus 4, 25.168. People, looking at the adjustment of 6 lakh rupees, it fairly looks like you are going to have a better answer in old tax regime only, which means, you are going to have a better answer in new tax regime only. So I would suggest going for new tax regime here, not for old tax regime. Yes, so by that logic, answer is new tax regime is the answer, because only changes additional depreciation. Again, I have not computed the answer. If the answer comes with minute differences and old becomes better, that is what the statement is. Only when you compute will you get the answer. I did not have time to do that, so I'm not doing this in the video right now. I have a feeling that 6 lakh is the only reversal which is happening in new tax regime, and therefore new tax should be better is what my gut feeling is. Yes, I'm leaving the thought there. I don't know what the right answer is, but this is what the adjustment is. I think looking at the question, people, the only thing which one student could have made a mistake is on the non-compete fee, treating that non-deduction of tax at source at 30%, and this part of the branch office. I think the branch office could have been a little bit tricky for you, and you could have probably spent too much time on realizing this adjustment. Other than that, I think all adjustments are from the past exams and should have been able to answer properly. Yes, so not a difficult question, but yes, definitely lengthy, very lengthy adjustments, people, because 15 marks ke liye, the adjustments they've asked with the reversal, with asking new tax regime and old tax regime, I don't think this was worth it. Yes, could have taken a lot of time out of you. So if you've done it in the last, you would have saved time for other questions. Nevertheless, this is what the adjustment is. Clear? Yes, good. That brings me to question number 2. Now, question number 2 was a peculiar one. I did not expect this to happen, but nevertheless, question number 2 comes in for the first time on capital gains. Question number 2A comes and gives you a very small understanding on capital gains, but yes, a very beautiful question, because while students were focusing on one adjustment, there were actually 3 different adjustments in the question. So look at the question carefully. It says, I am A Limited, an Indian company, and is a wholly owned subsidiary of another Indian company. Yes, 47 gets triggered. 47 says when a transfer happens between a parent company and a wholly owned subsidiary, whatever assets you're going to transfer will not be treated as capital gains if the assets which are acquired are not converted into stock in trade for a period of 8 years, or the shareholding does not change for the next period of 8 years. Any of that happens, whatever capital gains you exempted earlier will become taxable in the original year when the transfer took place. Clear? Remember, keep that in mind. So what has happened is, on 1st October 2020, A has sold a plot of land to E Limited for 35 lakhs. Plot was purchased in 2010 for 50 lakhs. Abhi ke liye I am going to say exempted from tax, not taxable in 2021. On 1st February 23, E Limited converted the property into stock in trade. Yes, they have converted into stock in trade at the value of 60 lakh rupees. Conversion was not allowed. You should have not done the conversion. Because you did the conversion in the original year 2021, whatever profit you made will become fully taxable. How will you tax people? This is before 23rd July regime. Before 23rd July regime, what will you do? Sale price was given as 35 lakhs. Full value of consideration is 35 lakhs. Purchase price is 15 lakhs. Take the 15 lakhs into indexation rules. Indexation says take the sale value of 2021, which is 301. Take the purchase price of 1011, which is, I'm sorry, this is Jan 2010. Yes, take the purchase price of 910, which is 148. Yes, so this is what your indexed cost of acquisition would be. Take the index cost of acquisition, take the full value of consideration, and that becomes your capital gains taxable in 2021. First. Second, now coming to the conversion which took place, E Limited has converted it. Conversion rules are different, people. Conversion rules come and say when you convert any capital asset into stock in trade, whatever is your fair market value on that date or the STV on that date, depending on the asset, will be treated as a capital gains and will be taxable only in the year in which the stock is sold. So I have converted on 1st February 23. On this date, conversion calculation will take place, which means my full value of consideration is going to become 60 lakh rupees. And on the 60 lakh rupees, I am now going to go cost of acquisition. Look, no people, my purchase was on 2021. 2021 ke baad February 23 is when I have converted it off. So 2021 say if I do, how much will it come? 1st October 20 to 1st October 21 is 1 year. 1st October 21 to 1st October 22 is 2 years. I have gone more than 2 years, which means it is long-term capital gains once again. With that long-term capital gains coming into picture, I can now again calculate capital gains, which means cost of acquisition will be the revised value of 35 lakhs. So take the revised value of 35 lakhs multiplied with the conversion year. Conversion year is 1st February 23, which is 22-23, which is 331. Divided by the year of actual purchase from A Limited, which is 2021, which is 301. Yes, so 301 is what I'll get my indexed cost of acquisition. This indexed cost of acquisition will get me the answer of converted capital asset order, capital gains. That capital gains will be put on hold. I will not do anything with it, but I will tax it in the year of final sales. Yes, next, the plot of land was then finally sold by E Limited on 30th June 2024 for 65 lakhs. Now, stock in trade has been sold off. E Limited is going to pay tax under PGBP for this. Yes, so what will E Limited do? E Limited will come and say, I sold for 65 lakhs. My purchase was 60 lakhs, which means my gain is 5 lakh rupees of PGBP income. That year of 24-25, I will also tax the capital gains. So 3 adjustments is taking place. A Limited will be taxable for the original sale to E Limited. E Limited will be taxable for capital gains of the conversion, and E Limited will be taxable for the PGBP income on the sale of stock in trade. These are the 3 adjustments which took place. If you have done this properly, amazing. You have read the chapter properly. If not, yes, I can agree to the fact that the question was a little bitty tricky. Yes, to realize all those things may not have been an easy thing. If you have done it, amazing. If you have not, it's okay. Now that you know it, do it properly next time if you get an opportunity. Yes, yes. So beautiful question, people. Sale, original transfer taxable for A Limited, conversion taxable for E Limited, final sale taxable for E Limited once again as PGBP. Clear enough to go? Yes, I think 2A was the only difficult question if you come and ask me. Other than that, I should be able to answer all the questions. Let's look at this. 2B is a buyback question. This is your buyback amendment. Again, it already got tested in your September attempt, but nevertheless, they still tested you once again in your Jan attempt, which is interesting. So let's look at this. It says IMS Limited domestic company purchasing its own shares on 10th November 2024. People, 10th November 2024 is after October. Buyback rules of dividends came into picture only when it came from 1st October, which means 10th November buyback rules will apply. Buyback dividend rules will apply to you. The consideration for buyback is given as 25 lakhs, which is a, what is happening? The consideration for buyback is given as 25 lakhs, which is going to be a sale value on the same day. The amount received by the company for issue of 10,000 shares having face value of 100 per share and 15 lakhs as given to you. Not relevant, people, because I am only going to be looking at what the shareholder did here. Next, Rohan, who has acquired 100 shares of S Limited at 150 per share, sold these shares to Divyam at 200 per share on 1st March 2023. Notice, I have sold it on 1st March 2023, which is before the buyback period. Divyam has received 250 per share in the buyback scheme of S Limited in respect of the 100 shares purchased from Rohan, which means Divyam is the one who is entering into the buyback scheme here. You are required to compute the additional tax payable by S Limited. What additional tax will S Limited pay? Nothing. The buyback took place in November. After October will not be applicable for additional tax. Answer is nil. Yes, it's not going to be liable. Had this been before October, I would have said yes, you are going to be liable for 115 QA, which is your buyback taxation rules. But here it is November, therefore no buyback rules will apply to you. Discuss the taxability of the amount received on account of buyback of shares of Divyam. Divyam has two things. Divyam has received 250 per share. So this 250 per share will become his IFOS income, buyback dividends. How much price did he purchase it for? He purchased it for 200 rupees. This 200 rupees will become his long-term or short-term capital gains. Let's check. Nothing is mentioned, people. I don't think I have been mentioned what it is, so I'm going to say it is capital loss. No mention of long term or short term, because it just says Rohan has Divyam has acquired it from Rohan. When did Rohan buy it? I have no idea. Yes, I'm not going to make an assumption whatever. I can make an assumption that Rohan acquired it on 2021. Yes, so by that logic I can come and say otherwise, but nevertheless let's not make an assumption there. I am not going to get into that discussion, so I'm going to say capital loss and I'm going to leave it there. Yes, so my money received is IFOS, my amount paid is CG loss. That is what the statement is. Next, will your answer be different if S Limited is a foreign company? They're asking what happens if S Limited is a foreign company. Will your answer be different? Yes, my answer will be different. Not the fact that you will be taxing buyback tax here. Understand, buyback tax as a rule was only introduced for domestic companies. This is still a foreign company. Foreign company mein what was the rule? It said even in those times when it was no buyback tax, foreign company was only liable for capital gains taxation. Which means the same thing will change. What will happen is Divyam will now come and say that I am not going to take the money received under IFOS. I would rather take the money received under capital gains. Full stop. That is what the statement will be. So what is going to happen? Divyam is now going to say, because the buyback took place on 10th September, which is before October, Divyam will come and say the money received will be treated as my full value of consideration for capital gains and my amount paid will become cost of acquisition and I will compute capital gains here. That is what the statement will be. Full stop. That is what the answer is. Nothing else, people. Yes, so you didn't have to give any other alternate answers. Don't change your answer accordingly. This is what the right assumption would be. Clear? Yes, that is what the answer is. I think this was definitely a manageable question. Very easy, simple, straightforward question. Nothing difficult about this. Yes, good. That brings me to 2C, standard non-resident taxation. However, yes, I would like to take this opportunity and tell you, for the very first time, I feel non-resident taxation does not look like an NR taxation topic. Yes, various kind of adjustments have been asked in this. Does not even look like it's an NR related topic. So many weird things which got tested. Let's see if you understand the question. Yes, question says, Mr. Manoj, aged 47 years, born in India, left for employment in United States in 2010. Person has been outside India in 2010 itself. Since then, he has been staying in USA and his wife is residing in Delhi. Wife is somewhere else, he is somewhere else. Okay. After financial year 10-11, Mr. Manoj never stayed for more than 30 days in India in any financial year, which means Manoj has now confirmed himself to be an NR, non-resident. He remitted $40,000 in joint bank account maintained with his wife in Punjab National Bank, Delhi branch on 10th April 2011. He has given some money to his wife. Transaction between related parties exempt from tax. His wife has invested in his Manoj's name 13 lakh rupees in the listed shares of domestic company on 20th April 2012, which means wife itself is coming and telling, I have received the money, but I will not put it in my name, I'll put it in Manoj's name. Even if she would have put it in her name, this was clubbing provisions. Nevertheless, it is not important here because money has been put in name of husband. The consideration was for the purchase of shares which was paid in USD and the translated terms as in INR. 2nd March 2025, these shares were sold for 15 lakh rupees. STT was paid both at the time of purchase and sale, which means assets are now long-term capital gains under section 112A. Yes, 112A is what is going to be the answer here. Now, yes, you can come and say Rahul, listed shares, foreign exchange assets, non-resident income, non-resident Indian taxation rules will apply. Unfortunately not. While that's what I was telling you, this question looked like it would have been from NRI taxation. It was not. The question did not ever come and confirm to you that you want to do NRI, which means you have to do normal rules. 112A rules will apply to you. Now that's where I felt a little unhappy here. Notice the question says it is STT paid, which means 112A, and the asset was purchased before 2018, which means they should have given the FMB of that date. FMB of 2018 should have been given, and you should have done that weird grandfathering computation. Unfortunately, that is not given to you here itself, which means you had to make an assumption saying the cost was a good number. Yes, so I sold for 15 lakhs, I bought for 13 lakhs, and therefore my gains of 2 lakh rupees will come into trigger. 112A will come into picture. 2nd March 2025, which means after 23rd July, I will tax at the rate of 12.5% after 1.25 lakhs. On 10th March 2025, Manoj has acquired a vacant land from Tulsi Foundations, a welfare trust under 12AB for 30 lakh rupees when the stamp duty value was 40 lakhs. One of the most beautiful adjustments, people. Why in non-resident, I have no idea. But understand, IFOS 56210 comes and says when any kind of asset has been acquired from a charitable organization under 12AB. When a 12AB organization ko you give an asset or you take an asset from them, then the IFOS rules will not apply. Gift rules does not apply, which means even though he bought it for 30 lakhs when the guideline was 40 lakhs, it does not matter. The 10 lakh rupees will not be taxable in his hand because it is from a charitable organization. This is something that you had to keep in mind. Yes, I'm assuming if students would have not read IFOS chapter properly, this could have been a miss out from your side, but this is what the rule is. Next, he has the following incomes in the current year. Dividend has come from 55,000 of X Limited, an Indian company. IFOS income. People non-resident receiving dividend from India, taxable at 20%. Next, interest of 20,000 rupees credited to his NRE account. I remember putting this very specifically and giving it to you during preparation times also in NR taxation. NRE account level, the interest is always exempt. Whether you are a resident or a non-resident, it does not matter, will be exempt. Next, royalty of 2 lakh rupees gross for received for authoring a book on literature from a publication at house in Delhi. Again, royalty will be taxable as per the special rules of 115A. No mention of PE conditions here, and therefore I would go IFOS at 20%. Now, people, the wife is sitting in Delhi, therefore is there a PE in India? No, definitely not. Can't take that into consideration. The PE is not established and therefore will be taxable at 20% without any expenses. During the financial year, he has paid a premium of 2 lakh rupees on his life insurance policy in India. Now, this is where the trick is. While you would think Rahul ATC will come into picture, there is nothing to claim ATC on. ATC can only be claimed on any kind of incomes which are not part of special incomes, which means you could have only claimed it on slab incomes. There is no slab incomes in the question itself. Upon what will you claim ATC on? The interest on NRE account is probably what you could have had, but that is also exempt. The guideline value has become exempted out of the bat. 112A is also special income, which means nothing to claim chapter 6A deduction on. There was nothing you could have claimed this chapter 6A on, and you should have ignored it off, which means you should have skipped this point, not relevant at all. Compute the total income and tax liability assuming the person is opting out. Notice the question says ignore the provisions of chapter 12A, which means NRI taxation was not requested out of you. Average of telephonic transfer buying rate and selling rate. This is something where they were trying to trap you. People, to convert your capital gains into foreign currency and all those things is only a conversation which you do if you are into NRI taxation. You were never into NRI taxation, you were always into 112A conditions. When you were into 112A conditions, there was nothing to do with this thing, which means this was to be skipped off. And then cost inflation index would anyway not come into picture because nothing was 112, it was 112A there, and that is what the answer would be. That is what the answer to be. So yes, difficult question, people, to a certain extent that they were asking you some tricky points here and there. I'm not telling this was not answerable. Definitely answerable because things were easy enough to that extent. Had you read things properly, you would have got this completely. But yes, they were trying to confuse you on various aspects. Small, very small things which has been tested out of this. I would say out of all the questions given to you, I would have preferred if question number 2 was skipped this time. Yes, now I normally suggest question number 5 should be skipped, but this time question number 5 was manageable, which means 2 would have been skipped off. If you had skipped off 2, you would have scored a better mark in this examinations. Yes, good. Let's read 3. 3A says, IMJ Education Center Charitable Trust of 12AB running school for primary and secondary education. Following details are given to you. They are asking you to find out the compute the total income. Total income has been requested. Easy question, people. It says gross receipts from students towards admissions added as income. Interest from tax-free bond exempted under 1015 does not matter. I am in charitable organization. Charitable organization says you can only exempt one income, which is your agriculture income, 10-1. 10-1 is the only thing which you can exempt off. This is not going to be exempted off, which means fully taxable. Next, voluntary contributions received at 10 lakh 50, out of which anonymous is 1 lakh 50. What will you do? Take the 10 lakh 50, 10 lakh 50 ka 5% of 10 lakh 50 will become 5.25 lakhs. 5.25 lakhs will be treated as normal donation. The differential number will be treated as, I'm sorry, one second. Let me check. Give me 1 second. Calculator. Yes. So I am noticing that the voluntary contribution is 10.5 lakhs. Yes. So 10.5 into 5% will give me 0.525. Yes, 0.525 is what I'll get. So 0.525 basically means 50,000. Let's put it into lakhs. Yes, 52,500 will be my normal income. So what should I do? I should come and say out of the 1.5 lakhs, 52,500 was my normal income. Yes, so 52,500 will be treated as my normal donation, and the balance is what I'm going to tax at the rate of 30% as anonymous donation. This is what the answer should be. Yes, sometimes giving these numbers in round off can always be confusing, so it's always better to do the answer in full numbers. Next, government grants corpus fund. People, the question says the money is coming from corpus. Corpus assumed it is invested in 11.5 modes. I'm going to treat it as exempt, not relevant at all. No mention here. Always make assumption that it is in 11.5 modes. Next, salary to teachers and administrative staff, which includes salary expenses of 5 lakhs not paid. People, the rules of charitable organization require that you should only allow expenses on cash basis, which means this is on mercantile accounting, cannot claim as expense. So 40 lakh rupees gets deleted off and 35 lakh is what you're going to claim as deduction. Next, other general expenses includes payment to grocery of 60,000 rupees by uncrossed check. 40A3 rules come into picture. Can't make payment more than 10,000 in non-permissible modes. Since you made payment more than 10,000 in non-permissible modes, the excess payment will not be treated as application, which means out of 20 lakhs, only 14.4 lakhs is going to be treated as application. Next, land belonging to trust in a nearby village was sold where the purchase price was 5 lakh rupees. Another land adjacent to the premises was purchased for 12 lakh rupees to be used for playground of children. This is what the adjustment is. Now, to answer this adjustment are two options, people. ICI prefers on both the methods. Honestly speaking, ICI would come and say method number 1, compute capital gains. Capital gains in this case is 10.5 lakhs minus 5 lakhs, which is 5.5 lakhs. So they will say 5.5 lakhs will be added to the gross receipts, claim the 15% set apart, and then again claim this 5.5 lakhs as a full deduction because you have invested 12 lakh rupees. But because you were only supposed to invest 10.5 lakhs, the differential 1.5 lakhs which you invested can be claimed as an application. Additional application can be claimed. This is method number 1. Method number 2, which normally is recommended in ITRs. ITR will come and say don't compute capital gain and all. Sale value will be fully treated as as a receipt of 10.5 lakhs. Claim 15% application and then separately claim the full 12 lakhs as a deduction. Yes, which means alternative number 1 is preferred in ITR method, where in ITR you come and say take the full 10.5 lakhs and reduce 12 lakhs, and alternative number 2 is where you take 5.5, reduce 5.5 and then additionally claim the 1.5 as a reduction. This is what two options are. Now, which option should you choose in exam? Both are right. Rahul, our answer technically looks the same. No, it is not the same. Understand, in the first scenario, when you do 10.5, you will take 10.5 ka 85%. And here you will only take 5.5 ka 85%. This is what the important difference is. Yes, and therefore it is important that you choose the right number. When you choose 10.5 ka 15% set apart, you will get more application to claim as exemption. However, if you take 5.5, then technically the 15% becomes way lower number, and so to that extent the answer will have an alternate assumption. You can do either of the two, both should be fine. Whatever has been taught to you is correct answer. Go with your guts, it's completely fine. You would get the right answer accordingly. Yes, so yes, a very easy question, people. Should not have been complicated except for the lakhs and everything. You could have got a full mark in this question, but lengthy. Definitely lengthy. For a 6-mark question, this does not make sense. You would have had to put a lot of efforts into this lengthy paper, people. Yes, good. 3.2 comes and says an education institution has an annual receipt of 4.95 crores during the financial year 23-24. The institution has claimed an exemption under 1023C3AD. Assessing officer has denied the exemption on the ground that the education institution has not made an application for approval under 1023C. Examine the action of the assessing officer. One question we have seen so many times in the book itself. I also have it in my solutions guide as well, people, where it comes and says if your gross receipts are up to 5 crores, you are directly exempted under 1023C. You do not have to get any approvals whatsoever. You do not even have to do anything for application purposes. Simple, straightforward, claim it as full exemption as long as you file your returns properly. Yes, so to that extent, the assessing officer is wrong here. He did not even have to ask you for an approval. You do not even have to ask him for an approval. Straightforward exemption will be granted to you. Yes, easy question. Next, Mr. B is Dhruv, a resident individual, age 62, senior citizen. People, keep in mind, because this was an old tax regime question, you would have had to claim and tax up to 3 lakh rupees as in basic exemption limit. Furnished to the following particulars for country A and country B. Income from profession country A 8 lakh 50, PGBP fully taxable. Agriculture income in country A is given there, therefore fully taxable. Now people, this is country A, therefore it becomes double taxed income. Keep it into mind. Dividend from in company incorporated in country B is 1 lakh 60. Again IFOS, double taxed income. Keep it in mind. Royalty income from literary book in country A is 5 lakh rupees. OS income, standard adjustment, always examination gets you. Next, expenses incurred for royalties 55, reduce that, but also keep in mind that you can claim 80 QQB. Yes, an 80 QQB of 3 lakh rupees can be claimed as double taxed income for your deduction purposes. Business loss in country B, again business loss to be set off against your normal PGBP income, you can set it off. House rent from country B, people, house rent from country B, HP rules will apply. Municipal tax paid is not allowed in country B, does not matter. In country India, you have claimed it as deduction, so you can claim it. 2 lakh 10 minus 10 is 2 lakhs. 2 lakhs minus 30% will become income from house property. Interest on fixed deposits and savings in Bank of India, 55,000. If you have noticed the date properly, you will know you can claim 80 TTB as a deduction. Yes, so 80 TTB will be given to you as a deduction in this question. India has not entered into any DTAA. Business loss is not eligible to set off in that country. I don't care. We have set off. Rate of tax is given as 10% and 20%. They ask you to compute the tax liability if the person has opted out, which means you are going in old tax regime. Yes. I think one of the most easiest questions you could have got in examination. This same question is part of your ICS study material itself. They have not even given one tricky adjustment in this. Every single thing was from your ICS study material. The same question has been copy pasted with some number changes. So you could have been able to answer this question very easily off. I really hope you have done this properly. Thumbs up if you have done that properly. Yes. So yes, 3 looks like something you could have easily answered off. 3A was lengthy, but nevertheless 3A, 3B could have been easily answered off. This should have probably been one of the top questions you should have answered when you started the chapter itself, when you started the exam paper itself. Yes, good. Next one says, examine the applicability of provisions of TDS and TCS in the following cases with independent scenarios. Question says, Mr. Rohan has sold his urban agricultural land. People, sale of capital asset 194 IA will come into picture for a consideration of 49 lakhs. Stamp duty value of the property was 51 lakhs. Question 194 IA comes and says that whenever it is 50 lakhs ka limit, 50 lakhs ka limit is STV or consideration, whichever is higher. Both Mr. Rohan and Mr. Sohan are resident Indians. Land was sold by Rohan as a capital asset. 194 IA will say take the 1% TDS on 51 lakhs or 49 lakhs, whichever is higher. So you have to do 1% of 51 lakhs. Simple, straightforward adjustment. Now I do remember discussing this in class as well with you people, that if you notice 49 lakhs ka 110% will be more than 51 lakhs, which means technically in capital gains full value of consideration should only be 49 lakhs. In capital gains, you will not take the full value of consideration as 51 lakhs, but we did write a specific note in class also where we came and discussed in TDS chapter, it does not matter. In TDS, even if the capital gains full value of consideration will be 49 lakhs, for the purpose of TDS, you will do 1% of 51 only. You will not do it on 49, you will do it on 51. That is what they were probably trying to test you here. Be careful. Second, cooperative bank has given you the following information. The following information says I have 2 cash withdrawals. One is Mr. A savings account, Mr. B current account. All cash withdrawals are happening in the current year. Mr. B has not filed his return of income for the last 3 years, whereas Mr. A has regularly filed his return. People, 194N cash withdrawal comes and says normal rule is you have to not do any TDS up to 1 crore rupees. After 1 crore, you will do 2%. If you are not a person filing returns on time, limit will start from 20 lakhs itself. See, Mr. B has not filed his return, so Mr. B is going to be tricked here. Mr. B will come and say in the 23 lakh rupees, 20 lakhs pay no TDS. 3 lakhs will go for 2%. The balance 75 lakhs also will go for 2%. However, coming to Mr. A, since Mr. A has done his job properly, returns have been filed on time, up to 1 crore no TDS. So 45 lakhs pay no TDS, 60 lakhs if you add becomes 1 crore 5 lakhs. So I will not do TDS on 55 lakhs here. I will do TDS only on the 5 lakhs here, which means 5 lakhs at the rate of 2% is what I will do TDS on. That is what the answer is. I have no idea why I say I wanted to give 4 marks for this. It was that easy. Yes, you could have easily given it in 2 marks itself, which means TDS was the easiest question that you got in examination. Again, looks like 4A is a very easy question you should have answered. Third one says, Mr. Rohit is resident, has received 9 lakh rupees on 30th June towards maturity of life insurance policy taken on 1st July 2021. For which sum assured is 8 lakhs and the annual premium is 2 lakh 50. 194 DA will come into picture. 194 DA will come into picture, which comes and says, if you're going to take a life insurance policy and the premium paid on the policy after 2012 is more than 10%, the policy will become taxable. If the policy becomes taxable, you should have received amounts in such a way that the income element alone will be liable for TDS. Yes, which means the total consideration amount that you should have received should be more than 1 lakh, but the income amount is alone liable for TDS. And therefore, in this case, if you notice, the premiums have been paid off 2 lakh 50. 2 lakh 50 ka premium, if I've paid it for 3 years, I think. Yes, 21, 22, 22, 23, 23, 24. Yes, 3 years I've paid. 2 lakh 50 pay 3 years is 7 lakh 50. 7 lakh 50 ka premium I have paid and I got a money of 9 lakh rupees. Yes, which means 1.5 lakhs is what is going to be liable for TDS. The 9 lakhs minus 7 lakh 50,000 will be liable for TDS, which means 1.5 lakhs will be liable. Now, because this happened before 1st October, I will be liable for 5%. Amendment after 1st October, it is 2%. Before 1st October is 5%. So this was a 5% thing. 194 DA is not something many students read and go for your examination. So I'm assuming this 2 marks would have been skipped off from your side. But then again, if you have read 194 N itself, 4 marks bonus here. Yes, so to that extent, you should have done a good job. TDS should have been answered from your side. You should have done this properly. Yes, good. Let's check on 4B. 4B is a TP question. People, this question, I was so impressed about looking at the question. I don't know, for some reason, it looks like ICAI has lost all its, innovations to ask a new question. Study material cup question given to you. Yes, a cup question, CPM question, cost plus method question given from your study material outright, just like that. Just one adjustment was changed from ICAI perspective. Other than that, the question remains the same. Let me show you the question. It says, Canada Limited is a company incorporated in Canada holding 35% voting power in LMN. The moment you saw more than 26%, answer is A. LMN Limited is engaged in providing software development and consultancy services. India is providing software development services both on-site and off-site. LMN Limited billed Canada Limited for 120 hours at the rate of 3,600 per man hour, which means I have billed my group company for this much. The total cost incurred for this project was 4 lakh 50. They have told me what is my unrelated cost, my cost from unrelated parties. Yes, this is my starting point. LMN Limited during the financial year has provided similar services to XYZ at the price of 5,400. Now here is where you end up making mistakes. If you take this 5,400 and come and say, Rahul, let's do cup method, 3,600, 5,400. No, I'm sorry, wrong answer. This is not cup, this is cost plus. This is cost plus. You should have not done that. So you should ignore this information. They have earned a gross profit margin of 50% of its cost. This is my starting point. This is what I call as my normal gross profit. Yes, so my normal GP is given to me right now for me to do cup method, for me to do cost plus method. Next, the transactions of LMN and with Canada Limited and XYZ are subject to this comparison. Now here is where you end up generally making errors. Pluses, minuses, very carefully look at it. Let's see if you understand it with me. First adjustment says LMN Limited derives technological support from XYZ, third party. There is no such support received from Canada Limited. The value of technology support received from XYZ is 4% of normal gross profit. Notice people, my third party is giving me technology support. If my third party is going to give me technology support, I am generally going to charge them more or I'm going to charge them less. I'm going to charge them less, which means third party GP is showing lesser. I always make a change in my third party GP because 50% is my starting point. So therefore, I will say my third party has been charged lower than what my group company is, and therefore I need to add. Yes, so first adjustment, add the 4%. I hope this makes sense. Next, Assuming that Canada Limited gives business in large volumes, LMN Limited has offered a discount to Canada Limited, a quantity discount which is 20%. Now my group company has got a quantity discount. My third party has not got the discount, which means third party GP is higher. If third party GP is higher, third party has to be brought down, which means I will less. Next, I am having, in case of rendering services to Canada Limited, LMN neither runs any risk of marketing cost. On the other hand, for LMN Limited, they are assuming a risk of marketing and therefore that is 10%. Understand? Third party, I am bearing risk. If I'm bearing risk, I'm going to charge them more, which means I'm now going to charge more to my third party. My group company is lower, my third party is showing higher, therefore I will show less. Yes, I hope you understand what I'm doing, people. This is how you have to approach this TP, otherwise it becomes extremely complicated. Last one, LMN Limited has offered 1 month credit to XYZ Limited, a cost of providing this services being 2%. No credit was given to third group company, which means group company did not get credit, third party got credit. Now people, when you generally give credit to your third party, you will eventually charge them more also, because you need to sponsor your working capital. So which means my third party has been charged more. If my third party has been charged more, my third party GP is higher. If my third party GP is higher, my group company is showing lower, I will minus. Yes, so this becomes minus, which means now if you notice, I have all the adjustments in my hand. 4 minus 20 minus 10 and minus 2. If I do this, it is minus 32 plus 4, which is minus 28. So minus 28% of GP is my material difference. And so what will happen is, you will come and say 50% was my GP, 28% of 50% is my material impact, and therefore 36% is my ALP GP. Is my ALP GP. I hope this makes sense to you. Yes or no? Yes. With this, I think I can fill my answer off. What is my third party cost? My third party cost is 4,50,000. My normal GP at the rate of 36% has been confirmed to me as 1,62,000, which means I should have billed my group company 6,12,000 rupees. However, question came and told that I have only billed my group company for a price of 120 into 3,600. Yes, so taking this 120 into 3,600, I think the price will come around 4,50,000, 4,32,000, which means I have an ALP adjustment of 1,80,000 as my answer. Yes, this is what the statement is. I think this is what the statement should be, people. You have to take the answer accordingly. Now the number is significantly lower. 1 lakh is not a big number for ALP adjustment also, but nevertheless, this is what the answer is. This is how you should have been answering this question. If you have done your proper question from solutions guide, you would have got the answer. Now, what is different between the question bank and this answer? In question bank, this was ulta. In question bank, this was ulta. They would come and say technology support will be given by third party, will be given by group company. Third party does not give, which means in question bank, this would have been minus. And second, when it comes to credit, they would have come and told that the credit was given to group company and not third party. These are the only two changes that they have made in the question. Other than that, the question remains the same, which means if you have mucked up the question bank and gone, you will definitely not get the right answer. But if you have understood the logic on how the ALP adjustment happens, this is what the potential answer is. Again, easy question if you have done the question bank, but yes, TP, careful. Yes, good, clear. So 4 is also done, people. I think we are already almost there. We are at 1 hour 36 minutes and we are already almost about to complete this off. Question number 5. Now, question number 5 is generally something which I ask you to skip always, but this time's question number 2 was a little tangy, and therefore question number 5 is what you should have answered off. Why? Because I'll show you the question. It was that damn easy. Question number 1 came and said that on 15th October 2024, D Private Limited has filed its return for 24-25. Within the due date is what I'm assuming, because it is 31st October due date. Yes, company 31st October. The return was found to be defective, and on 2nd April 2025, next financial year, the assessing officer has issued an intimation to correct the defect within 15 days from the date of notice. Company has rectified the defect on 10th, which means I had 15 days time, which means by 17th I should have done the rectification. I've done it on 10th itself. Things have done on time, no problem. Whether the assessing officer is empowered to issue a notice under 143(2) to 30th June 2026. No. This is a recent case law for your examinations, and I remember putting it on the YouTube video as well, that this question is expected in your examinations this time. See, it has come. This question is basically about the fact that generally 143(2) is issued within 3 months from the end of the financial year in which a return is filed. My return is filed on 15th October 24. 3 months from the end of the financial would have been 30th June 25. It wouldn't have been 30th June 26. But assessing officer says that, sir, when I gave you a defective response came in the next financial year. Because the defective response came in the next financial year, my 143 to timeline is also extended for one more year. No, that is not how it is. Yes, the case law comes and clarifies that defective is only me correcting my mistakes. The return was already filed in 24-25 and therefore the assessing officer should have issued the notice in 25-26. Because he issued the notice on 30th June 26, which is post the due dates, it will not be considered as a valid notice. The notice is time barred. Answer is no. Deep Private Limited contended that the notice under 143(2) can only be issued within 3 months from the end of the financial year in which the return is furnished. Discuss whether the contention of Deep Private Limited is correct. Obviously correct only. Yes, easiest question, people. If you have done the case laws properly, you would have easily got this question off. No difficulties here whatsoever. Question number 2. It says, by the way, the question says you have to answer any 2 out of 3, which means you didn't have to answer all the 3. One question you could have easily answered. Significant case loss was an easy question. Second, Mr. Chauhan has furnished his return of income for 23-24 on 23rd July 24, declaring an income of 16 lakhs. Assessing officer passed an order under 154, determined the income at 19 lakhs. So you went from 16 to 19. Officer has increased it by 3 lakh rupees. Mr. Chauhan claimed that the action of the assessing officer of enhancement of income is not in accordance with the provisions of the Act. He wishes to file an application before DRC, Dispute Resolution Committee. DRC has been requested to you to get the issue resolved. Whether an order under 154 is a specified order, yes, any assessment order 143, 144, 147, 154 are all specified orders under DRC. You can take that into consideration. If yes, what are the monetary limits? Monetary limits for DRC is very simple. The assessee's total income should be less than 50 lakhs and the variation should not be more than 10 lakhs. In this case, if my total income is less than 50 lakhs, which is 16 lakhs, and my variation is less than 10 lakhs because the variation is only 3 lakhs here, and therefore can I go to DRC? Yes. If you have read DRC, this is what the answer is. Easy question, answer possible. Easily you could have closed it off. Yes. Now if you have skipped off that chapter, it's a different conversation, but yes, this was an easy question you could have answered off. If not, let's see whether question number 3 is answerable. It says, Mr. Roy is an Indian resident liable to collect tax under 206C, has failed to pay to central government the tax collected by him from customers during 23-24. Assessing officer initiated prosecution proceedings. Amendment of current year, compounding application. We discussed in detail about compounding and I told you compounding is expected in examination. September it came in MCQs, Jan has come as theory question. Mr. Roy applied for compounding of offences on 17th October 24, which is before the amendment due date, which was rejected due to non-payment. Okay, first application rejected. Mr. Roy also filed an application with CIT against the penalty imposed. On 8th October 24, Mr. Roy paid all the outstanding tax and demands, which means Roy has now surrendered himself. He has paid everything off. He again wishes to apply for compounding under the new rules of 17th October. Okay, so now he's coming once again and he's saying for the same offense, I would like to compound once again. Last time I was only rejected because I did not pay the taxes. Now I've paid all the taxes. Can Mr. Roy apply for compounding of offences under the new guidelines when the compounding application was already rejected? Yes. If it is curable defects where I have not paid my tax on time, there is no problem whatsoever. You can easily apply for compounding once again after you cure your defects off, will be allowed to you. Also, is he eligible to apply for compounding of offence when the appeal against the penalty is pending? Yes, you can do that. A compounding application can be filed anytime before the initiation of prosecution proceedings, during the prosecution proceedings, but not after the completion of prosecution proceedings, which means as long as the prosecution proceedings is going on, I am fine. I can apply for compounding here. I don't have a problem here. We can do a compounding here at any point of time. Should not be an issue. Should not be an issue. Yes, there is only one disclaimer, people, that when you're applying for compounding, you will have to file an additional affidavit. The affidavit should come and say that I'm withdrawing my appeal if I'm going for compounding. If you go for the withdrawal, then it is completely fine. After the prosecution is completed off, you will have to withdraw for the appeal. That if you do, completely fine, should not be a problem whatsoever. Yes, next. By which date Roy needs to file an application for compounding under the revised guidelines? There is no timelines, absolutely no timelines for filing a new application. If you file an application after 1 year from initiating prosecution proceedings, I will just ask you to pay extra 50% on the compounding piece. Other than that, there is no timelines to complete it. Just make sure that before the prosecution is completed, you have filed the application of. That is the answer, simple, straightforward, which means this, again, if you have read the amendment, you could have got it. So if from the case law perspective, new case law, new amendment, both the things, if you would have read it properly, question number 5 was easily answerable. Better than question number 2 at any point of time, I would say. Yes. Good. That brings me to question number B. Now again, I know Rahul, you'll say, how does this make sense? 6 marks I would have wasted here. No, compared to question number 2, this was far better. Look at the question. It says, explain the terms most favored nation and base erosion and profit shifting with respect to international taxation treaties. People, base erosion and profit shifting is the first chapter itself. You can simply come and say, write your own English. You simply have to come and say, when it comes to base erosion and profit shifting, when profits are being shifted from one country to another by abuse of treaties and all that stuff, it is called base erosion and profit shifting. OECD is the one who's handling this. Most favored nation basically means that when you enter into a treaty with another person, and if another treaty is entered into with a third party with a lower tax rate or a lower scope, then that treaty can also be used in for the that conditions can also be used in my treaty. Yes, this is a very common thing which if you have done practically also you could have been able to answer off to that extent. Point number B comes and says Article 14 of UN Model Convention gives exclusive right to the source country to tax independent services. Examine the correctness of the statement. Answer is false. False, because independent personal services come and say generally the rights are given to your resident country, but rights can be transferred to source country if two conditions are satisfied. If you have a fixed place from which you will carry out this operations in the source country, or if you have traveled to a country for a period not less than 183 days. If that conditions have been satisfied, only then does it move to source country. Otherwise, it is not moving to source country. It can go to residence country also. That is what the answer was. Yes, a simple straightforward statement. I understand you would have skipped the chapter off. So yes, I don't deny it. 6 marks could have been skipped off compared to what you would have had to face in question number 2. Question number 2 was difficult to a certain extent. Capital gains could have gone wrong. Your buyback tax probably you would have got it right. But at the same time, your non-resident taxation also could have made a mess up for you. To that extent, I think question number 5A was definitely achievable for that extent. Yes, good. Last question, people. Let's complete it off. Question number 6. It says, I am MSP Associates, a partnership firm liable to tax under section 44AB, engaged in the business of food processing, providing relevant information to you for tax audit examinations. The data is given to me. Now, people, I was very disheartened by this. Very disheartened. I'll be very honest to you about this. We are in income tax, which means income tax laws, income tax limits is the first thing I need to keep in mind. Unfortunately, this question suddenly started expecting you to know what is the limits which are notified for MSME. Yes, now I will be very honest to you, for all my students who have taken classes with me, MSME has not been discussed in the class for the limit perspective. We have only discussed the rules relating to MSME, whether interest to be fully disallowed, payments and all under 43B, that we have done. But we have never discussed about the limits in the class for a very simple reason that I always felt this is not relevant for income tax. You already have enough numbers to remember in income tax. So testing this question was unfortunate, should have not done that. But hey, let me also give you this bright side. In this question, even if you did not know the limits, you could have actually answered the question very easily. I'll give you the limits right now just for your convenience. When it comes to micro enterprise, it is 2.5 crores worth of investment in plant and machinery and 10 crores worth of turnover. If you have not crossed this, then you're a micro enterprise. In medium, in micro and small enterprise, the number 10x, which means 2.5 becomes 25 crores and 10 crores becomes 100 crores. That is what the limits are given to you. Yes, now in this question, luckily everyone was a micro and small enterprise, so we did not have a problem. But hey, assuming that you did not even know that, you did not even know the limits and you're extremely confused, by looking at the dates, you could have given the answer. Section 43B comes and says that when it comes to micro and small enterprise, any kind of payment which is made after the financial year will trigger a disallowance if it is not paid within the time limits. Yes, which means if a payment is happening late, but it is happening during the financial year, it still does not matter. It is not going to trigger you at any point of time. And that was what the hint in the question was. ICAI was trying to trick you in the question to see if you will get confused or not. And that is what they successfully achieved. In this question, even if you did not know it is a micro enterprise or a small enterprise, you could have answered the question right away. Look at the question. It says, I have an entity called Teal Private Limited. Some turnover is given, some investment is given. You and I both don't know whether it is micro and small. Notice, date of purchase is 11th January. Date of payment as per agreement is 1st February. And date of actual payment is 28th February. Which means I have made the payment during the same financial year itself. I have made the payment during the same financial year itself. If I have made the payment during the same financial year, whether I would have made the payment on time or before time or after time, it does not matter, because you will never have a disallowance coming into this. Even if the payment was made late, current year you will disallow, current year itself you will claim. 43B requires that you have to only disallow those items which are paid after the financial year. So point number 1, out of the bat itself I can come and say not relevant. Correct? Understood? Read the second one. It says, I am Cian Private Limited. Date of purchase is 21st November. Date of payment is 1st December. And date of actual payment is 28th February. Again, notice, even though payment has happened after the due date, it does not matter because the payment happened within the same financial year. Which means even in this case, I can straightforward come and say whether the payment was made late or on time, it does not matter because payment will not be triggered under 43B. 43B only requires to disclose those items which are not paid within the financial year. Agreed, not agreed? Yes or no? Yes. By that logic, people, now you can come and say last one is the only thing pending. Whether last one is micro or small, you don't even have to make a guess because at the end of the day, you will have to report this. Look, it says Rust Private Limited. Purchase date is 1st of March. Payment date is 20th April, which is agreed for the next year. And MSME rules come and say you have to make the payment within 45 days. Notice 1st March say 45 days will not be 20th April. It'll be somewhere around 14th or 15th of April. Yes, by that logic, I have made the payment on 18th April, which is after the 45 days condition. If it is after the 45 days condition, this payment is getting disallowed. This payment is getting disallowed, and if this payment is getting disallowed, as a tax auditor, your responsibility is to disclose this payment. That's all. Yes, which means what are you going to do? You're going to ignore payment 1, you're going to ignore payment 2, you're only going to take into consideration a payment number 3. This is what I was trying to tell you. When I was discussing this in class also, I purposely came and told you the limits are not important. The limits will not be tested in examination because ICI does not want you to remember outside the syllabus topics. ICI would only like to test you on some important things, and this is what ICI did. ICI only wanted to test on the third part, and ICI made it very clear. Which means if you sat in examination and you were scared about the fact that Rahul and limit theory, I don't remember the limit, you have mistaken yourself. Yes. Keep that in mind. Discuss whether P Associates is in compliance with the relevant provisions of the Act and other related Act relevant to your tax audit. No, he is not compliance for Rust Private Limited. Bali 2, he is in compliance. Second, list out the points to be kept in mind while conducting the audit of P Associates for the purpose of clause 22. What are you going to keep in mind? You're going to go to the client and you're going to come and tell, dear client, I need the information relating to all MS payments and tell me what and all payments have happened. When have you made the payments? What is the terms of contract? Do you have a written contract or oral contract? Simple general English you just had to throw out. Yes, you could have easily scored this answer, and this question was not difficult at all. Correct? Yes, keep that in mind. Question number B. It says, discuss whether the provisions of GAR will be applicable in this current case. It says, Red Limited is an Indian company, incorporates Brown Limited as a wholly owned subsidiary in country Y, a no tax jurisdiction. Now, here is where the problem starts. Students at this stage will start assuming, Rahul, no tax jurisdiction, problem only, cannot be taken. No, read further. Brown Limited is engaged in manufacturing of cement raw material for which it is available at a lower price in country Y, which means now I have a proper reason why I wanted to go to country Y. I went to country Y for only one reason, I'm getting things at a cheaper price. Brown Limited has not paid any dividend to Red Limited, which means Brown and the Red, nothing has come. In that case, people, will you invoke GAR? No. GAR is only applicable when three things happen. Either there is no commercial substance, there was no reason for you to create that entity in commercial reasons, and third, if you have abusing TTs. Nothing of that is mentioned here, which means I will say GAR is not applicable here. If any transaction would have taken place, looking at the transaction, I could have come and said nothing is relevant to do this transaction. I would have said otherwise. Answer here is no GAR because I have a commercial reason to go to that country. Commercial reason being I can procure things at a cheaper price. Point number 1. Yes. Point number 2. Yellow Limited, an Indian company, is a wholly owned subsidiary of Pink Limited, a company incorporated in country H. Company in India is a wholly owned subsidiary of a foreign country. Pink Limited has decided to give a loan to Yellow Limited during the financial year 24-25. The DTAA between India and country H provides exclusive right to tax the interest to the resident state, which means India comes and says oh, Pink has given a loan to Yellow. Okay, sorry. People, it's not Yellow who's given a loan. Pink has given a loan, which means Yellow India person is going to pay interest outside India. And this states that the provisions of treaty come and say that you can only tax in resident state, which means I'm not going to pay tax in India. I'm going to pay tax in country H. Apart from that, country H provides tax exemption of interest receivable by a resident company from any entity in which resident company holds not less than 10%, which means now country H comes and says, first you tax in my country. And second, that country comes and says, don't tax because you are going to have more than 10%. In simple words, on this interest, no one is going to pay tax. No one is going to pay tax. P Limited does not have a P in India. Yellow Limited is able to claim interest deduction from its income and thus enjoyed a tax benefit of 1.5 crores, whereas Pink Limited also got a benefit of 2 crores from Country Hedge, which means Pink Limited did not pay tax in Country Hedge because 2 crores worth of benefit gone, and India also, because I paid an interest, I claimed a deduction. In this case, can GAR rules be applicable? Answer is yes. People, to invoke GAR rules, the total arrangement should give me a tax benefit of 3 crores. Notice 2 and 1.5 becomes totally 3.5. Total arrangement got me 3 crores more, and therefore GAR is applicable. Yes, a very simple, straightforward question, people. You can straightforward come and say there was no commercial reason to get a loan. You could have also got the loan from outside parties. Getting a loan here was for only one reason, to abuse the treaty, because the other country said no taxability. The overall tax benefit is more than 3 crores, and therefore you will get GAR benefits. You will get a GAR implication here. GAR is applicable. You can also write probably another thing, people, where you can come and say that in this case you can also invoke 94B. Because payment is happening outside India. In that case, 94B will come into picture. 30% of EBITDA has to be checked. Nevertheless, GAR and SAR can always coexist, and therefore to that extent GAR is applicable. You don't need to write that extra story if you want. If you want extra marks, good enough, you can write that story as well. Yes, good. That is what the answer is. Any difficulties here? Good to go. Question number C. Question number C says, analyze whether the following persons fall under the definition of applicant under 245B for the purpose of advance ruling. I think one thing ICA has made extremely clear to all of you: advance ruling is the only question which will be tested in 4C, which means in 7C, 7 or 6C, yeah. In 6C, which means one thing I've also made clear to my students as well, that advanced ruling is not a chapter you're going to skip no matter what happens in life. Advanced ruling is one chapter you're always going to read, and you're going to read in detail because a 4-mark free question is always going to come to you. See, free question. Advanced ruling basically comes and says, when do you have to file an application? Application is filed when a transaction is happening with a non-resident. Second, when a non-resident wants to file it for himself. Third, if a resident wants to do it for any transaction where the tax liability is going to exceed 100 crores. Fourth, any public sector company whose case is still pending, before any kind of court for a question of fact or question of law. And fifth, if it is any GAR implications. That are the 5 applications you can file for. Let's check. It says TBF India Private Limited, a closely held India company, needs to pay 75 crores to BIK Inc. of USA for some services provided by BIK. TBF wants to know whether such services falls within the definition of technical services, which means TIF India company is filing an application asking what will happen to the non-resident's income, and thus determine the amount of tax payable. The estimated tax liability in this transaction is 15 crores. Now, if students went confused and said 100 crores, no. Understand, when it comes to resident to non-resident transaction, no limits apply. You have to file an application to advance ruling without any implications. You can file an application whatsoever. It does not matter. Second, Fig Tree Limited, an Indian company, a private sector company, is considering entering into export contract with Lamau Inc. of China. Fig Tree Limited is expected to earn an income of 500 crores, and the tax liability would be 150 crores. You don't even have to go forward. People, the tax liability has crossed 100 crores. Resident person in India filing an application more than 100 crores, allowed, completely allowed. You can go and file an application. Third, I am not able to read this properly, but I'm just reading it out for you people. It says Universe India Limited, an Indian public company undertaking, is undertook a transaction with Moon Private Limited, foreign company. Expected tax liability in the hands of India Universal Limited is involved, is transaction of 56 crores. Now here is where you could have probably got confused. Notice people, even though transaction is happening with non-resident, I am not filing an application for the non-resident's income. I'm filing an application only for my income. My income should be more than 100 crores in this transaction, and it has not been that. Because the number of 100 crores has not been crossed, I will not be allowed to file an application here. Now you can come and defend saying that Rahul, the application is for the purpose of transaction with the foreign party. No, but here I am not here to look at the foreign party's income. I am here to come and assess about my incomes. My incomes is going to have a tax liability of only 56 crores, and therefore I cannot file an advance ruling. Not allowed. I'm sorry. Last one says BNHJ is an Indian public sector undertaking for the financial year, for the assessment year 23-24. It has a matter pending with tribunal. Matter ange mudinjichu. Yes, the moment you said there is a matter pending with tribunal, I would come and say application permitted, advance ruling can be allowed. I don't have to read further, but nevertheless, it says which involves question of fact in respect of transaction with a non-resident company. Tax liability is given as 105 crores. Now, people, whether you go for 100 crores or you go for 105 crores, at the end of the day, public sector company filing an application always allowed. Yes, if it is going to be a matter pending before court, you can always file an application. 1 rupee is also not important. Yes, so to that extent, answer in this is A, B allowed, C not allowed, D is allowed, and that is what the statement is. With that, your advanced ruling also gets over free 4 marks. Yes, and that ends my discussion of this analysis. Now, if I have to give you an overall summary, people, I think question number 2 was tricky. So yes, question number 2 should have been a little careful. Non-resident taxation, best avoided this time, would have given you more marks. Nevertheless, if you would have followed a proper pattern where you did not do question number 1 and 2 first, pattern where you did not do MCQs first, pattern where you started with question number 3, 4, 6 and all, you would have definitely done more in the paper than what you did earlier. Yes, so question number 3 should have been attempted, question number 4 should have been attempted, 5 if you could have attempted, great, 6 should have been attempted. Then you should have gone to your MCQs, individual ones. Then you should have probably gone and checked for the case study or the question number 1, as the case may be. If you would have followed that pattern, you would have been able to complete the maximum amount of paper in the least amount of time. I am not going to deny the fact that the paper was lengthy, but at no point of time was the paper difficult. There were some adjustments here and there which you could have gone wrong on, but beyond that, the paper was definitely manageable. You could have easily scored good marks in this paper, even enough for you to get an exemption. If I look at question number 6, easy question. Question number 5, manageable, at least, not ignoring the 6 marks if you want. Question number 4, definitely manageable if you have done your study material and all properly. Could not have been any difficult for that matter. And question number 3 was also easy question, could have been managed. With this itself, you could have easily scored your passing marks. And then in MCQs, there were no tricky questions. The VDAs and all could have been easily answered off. There were some DRC questions easily answered off. MCQs, yes, if you have done the MCQs reading first and not the question first, you could have spent more time, but it definitely was manageable. You could have answered every MCQ question without any difficulty for that matter. By that logic, I think this paper was definitely a above average paper and not difficult whatsoever, but still a good paper to score. If I'm looking at my analysis of this paper, people, I think most of the adjustments were from my solutions guide. I could not find any adjustments outside the solutions guide. The one question which probably I am also agreeing to the fact was new out of me was question number 2A. Question number 2A is not part of, we have discussed it in a class as an adjustment topic, but we've not discussed it in length of these 3 adjustments and all. So to that extent, yes, I could agree that this question is not from my material, but if you ignore this question, every other question came from solutions guide, which means if you have done the solutions guide also properly, not mugging up, but done it properly, you should have been able to do this paper to a good extent possible. This paper is not worth failing for. Yes. Yes, now I'm not going to criticize anyone for that. If you have not done your paper properly, probably it's time for you to reevaluate your performance and see how you have been managing direct tax. Conceptual clarity is something which you have to keep in mind for you to do a paper like direct tax. So if that is missing out somewhere, maybe it's time for you to start a little earlier than others and not wait for your results. But everyone else who has a little bit of a doubt also that Rahul, my paper went good or not, trust yourself. Don't get into that conversation. Trust yourself to that extent that you promise yourself, ki Rahul, I spent enough time reading for this exam and I know I will clear. Give yourself that relaxation so that you can enjoy your coming days. But next, after a couple of 2-3 weeks, you are anyway going to have that fear because your results are going to be announced maybe in a month's time. And so the 2 weeks, next 2 weeks is what you have in your hand for you to enjoy your life. After the 2 weeks, things are going to substantially change. For the better or for the worse, you will have a change in your life. People are going to look at you very differently than what you were earlier. You are no more an article for anyone. You are already a qualified professional. Yes, and so to that extent, I want you to have this time to yourself, enjoy the kind of childish behavior you can at this point of time and come out stronger, because I know you deserve to be standing in this position if you have attempted this paper to the whole of your heart. Yes, with that, I would like to conclude this conversation. I'm thankful for everyone who stayed with me for exactly 2 hours. I'm closing this at exactly 2 hours, which means I was able to complete the reading of this paper in 2 hours. Yes, writing will take a little more time, but the paper was manageable to that extent. I am leaving this platform with you. In the coming days, we are going to have some amazing amount of discussions on some very beautiful assignments, very beautiful discussions on how the CA final preparation should happen for May 2026. So yes, please watch out to this channel. If you have any friends who are writing May 26, September 26 and Jan 27, please do request them to subscribe to this channel and give me the heads up so that I can always be there for you to discuss whatever important there is for your examinations. On that note, I would like to sign off for today. Thank you everyone. Have a wonderful journey ahead. Take care. Bye bye.